the air, you make it more difficult for private agents to prosper. So there will be a slowdown because of that. We're thinking construction. Obviously, we're thinking margins as well. So a bit of a headwind until we see basically the Fed removing the pressure as they get closer to achieving their inflation target, which is obviously not now yet.
Sami, thank you very much for the deeper insight into Middle East economic matters. Always love a big fan of your work. That's Sami Shari, he's the chief economist at Bank Lombard, Wtdta and Chi. Well, so much more to come on the show. A very eventful morning. This is Bloomberg.
Policy, politics, from the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We're seeing oil futures extend a rally after OPEC Plus agreed to cut its output by the most in 2 years, earning a rebuke from the Biden administration at the White House. Bloomberg's Manus Krani joins us now from Vienna. I mean, we went into this meeting with a set of expectations, but those got blown out of the park, didn't they?
They did indeed. You know, the Emiratis tried to recast the stage before we all went into the building yesterday that this is not the politicization of OPEC, but petrol is politics, gas is politics, and a 6% rally in oil is politics. It's also macroeconomics for the global central bankers. 3 days that rebuilt a rally, underpinned a market, or did it set a collision course of a cataclysmic kind with the United States of America? That's what went through my mind as I drove over here this morning, reflecting on both the conversations with His Royal Highness Prince Abdulaziz bin Salman, the Saudi oil minister, who would not be drawn on the politics of this or the response to the White House in terms of Jake Sullivan and what he had to say. But I also sat down, Yusuf, we were busy last night, with Alexander Novak. The price caps are coming. Nobody's quite sure what they're going to be. The known unknowns, to quote Donald Rumsfeld. But this is Alexander Novak's take on caps and cuts.
Indeed, there have been two important decisions taken today. One, you have already mentioned, and that is the decision on cutting quotas by all countries present and by all countries in the group. But the second decision, which is just as important as the first one, is actually the extension of the Declaration of Cooperation, because it was scheduled to expire at the end of 22, but now it has been agreed that it will be extended until the end of 2023, which gives the market significantly more certainty and significantly more predictability. And that's why a decision was taken to balance the market out by these cuts, by cuts versus quotas of August. And especially this is very important ahead of the winter season, when we would also see the seasonal decline in demand by 2.5 to 3 million barrels. And this decision, which has been made today, helps the market to balance it out. I think it's a very weighted decision and a timely one.
let's look towards February 2023. You will have more sanctions, we assume. You will potentially have a price cap. Can you tell me with a surety what your production in February 2023 will be? You say 93% for 2023, but is that the worst case scenario by February with more sanctions and a price cap?
Such actions, as we're seeing, creates, i.e. the price cap, creates a very bad precedent, and will primarily hit the ones who are actually doing it and the ones who are implementing it. We know, and history has a countless number of examples of when market interference, especially with the mechanism of price controls, can only lead to a deficit of a certain good. This mechanism is unacceptable to Russia, and if it is implemented, we are not going to supply countries which join this mechanism.
Bottom line, what the market wanted to know, red-hot headline, price caps equals production drop in Russia. Who fills that void? Yusuf.
Manus, thank you very much. Outstanding coverage there from Vienna. Bloomberg's Manus Krajina is, of course, going to provide further perspective throughout the morning. I want to get to equity futures, give you a sense of where we are with risk appetite and getting a little bit better here if you're looking to go long on some of these plays. On the S&P 500 mini, we're still called higher by 0.5%. But again, it is all about global energy security and how the Vienna of yesterday rips that up. This is Bloomberg.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball so their apps would surface above competing apps in the list of results. Apple's push into ads is a little ironic given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are in Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
It's Start Your Business time.
Real estate is booming.
I should be booming. It's business time.
So, free yourself from this by going freelance. Get your thing started.
I'm the boss of me!
LegalZoom. Now you're in business.
If you need affordable general liability, workman's comp, tools and equipment, commercial auto, and even property insurance, Next has got you covered. Next is fast and easy. You can make changes, file a claim, and even get a certificate of insurance on your phone right from the job site. They've got a 4.8 rating on Google and an A+ rating with the Better Business Bureau, so you know you can rely on them when you need them. Go to Google and look for Next Insurance or go to nextinsurance.com.
Good morning. This is Bloomberg Daybreak Europe. I'm Danny Berger in London, and these are the stories that set your agenda. Biden rebuke. The White House criticizes OPEC Plus for its decision to cut output, calling the move short-sighted. Crude climbs for the fourth straight day.
Price cap creates a very bad precedent and will primarily hit the ones who are actually doing it and the ones who are implementing it.
Energy discord as OPEC Plus unites. EU Chief Ursula von der Leyen calls for limits on gas prices after the bloc acts on oil. Moscow says the move will backfire. Pivot? What pivot? Fed officials continue to pour cold water on prospects for a quick policy turn. Mary Daly tells Bloomberg there's a high bar for any change. Well, good morning. It's the day after an OPEC decision, a decision that some have characterized as the battle between OPEC Plus and the West. A cut of 2 million barrels per day means that we might face higher inflation, and we certainly have already faced the backlash coming from the White House and concerns there of what it means for prices at the pump. So you are seeing not much change this morning in Brent crude, but it is back above $91 a barrel. This is a gain of 6.5% so far this week. You did see 10-year yields, those ticked higher yesterday in response to all of this. Yesterday around this time, we're at 3.6%. We're at 3.7%. We are down about a basis point. But what we might be seeing now with a weaker dollar, 10-year yield not doing too much this morning, we do have non-farm payrolls tomorrow. It's a huge risk event. Any cracks might signify whether this pivot narrative from the Fed has any staying power. We've heard from Fed officials saying, nope, it does not. But still might just be some repositioning, some window dressing ahead of that. Same goes for equity markets. We saw this late day rally in the S&P 500 yesterday, ending the day little change. Well, that late day rally continuing into today's session. S&P and NASDAQ both up more than 0.5%. The big winner this morning, really solid gains in Euro Stoxx 50 futures, up about 1.33%. But again, how long can this last? A lot of risk events on the horizon. Well, along with gains in U.S. and European futures, we're also looking at Asia stocks that are higher for a third straight session. Let's bring in Annabelle Jewelers, who's in Hong Kong, for more on these markets. So, Annabelle, more risk on.
Yeah, that's right. What you were just pointing out there, Danny, is really what's underpinning the moves that we're seeing in Asia today, because coming into the session was actually pretty interesting. Futures were pointing to a weaker start, but then the trading for the E-minis got underway and we saw that moving high. So that's really being reflected today. A couple of things or sectors that we're really watching in particular. There's the energy story, of course, with the OPEC Plus production cuts. So we are seeing the energy index moving the broader benchmark higher. And then there's the chip story as well, because we had Morgan Stanley out with a report saying that the chip sector could recover into the second half of next year. So that's really also leading the KOSPI there. You can see that is the biggest gainer in the region. And if you bring up the KOSDAQ at the bottom of your screen, you'll see that tech-heavy index in Korea is really what is leading us higher. But in terms of the global backdrop, as you said, it's going to be interesting to see how long markets can ignore those bigger issues that are going on. So firstly, you've got these views that we're hearing from Fed officials. Mary Daly, the latest, saying this idea of rate cuts next year. Basically, the market has it wrong. So that's one of the big factors there that we'll be watching. And of course, if you have high oil prices, that does risk inflation becoming more entrenched. But the other factor as well in Asia in particular, if you bring up the terminal chart coming into this week, stocks were looking pretty cheap. So you've also got to look at, is this an opportunity for dip buying? And actually in Asia, we're on track for our best week now since November 2020. Of course, put it into perspective again, because we did come off a 7-week slide, and we've only seen that a handful of times over the past couple of decades. But still, as Danny will see, how long can this last?
Yep, certainly feels that it can't last much longer given how enthusiastic these markets have been. Annabelle, thanks so much. Annabelle Jewelers there in Hong Kong. Let's get to our reporters now from around the world for our top stories. Manus Cranny, of course, is still in Vienna, still abandoning us on the show for a little bit for the latest on oil and OPEC. Lubo Pernina joins us with a breakdown for the first ever European Political Committee meeting, and community meeting, that is. And Michelle Jamrisco joins from Singapore for our central bank update. Well, let's start with OPEC and oil prices trading slightly higher this morning, above 92 dollars a barrel after an action-packed 24 hours. We had OPEC Plus agreeing to cut its output by the most in 2 years. That, of course, earned a rebuke from the White House National Economic Council Director Brian Deese, and saying that President Joe Biden is disappointed by the short-sighted decision.
Well, we were disappointed that OPEC made this decision. As the president mentioned, we think it's unnecessary if you look at the global environment where supply continues to be the predominant challenge. We've been working for some time to take action and encourage action globally to make sure that supply actually matches demand.
And then on top of that, the EU approved new sanctions on Russian oil, which drawled a veiled threat from Russia. Let's head to Vienna with Manus. So, Manus, let's start with this rally in prices, up 6.5% so far this week on a barrel of oil.
So I was in the car on the way over here and I thought, what is it? What do we do for 24 hours in Vienna? Job done? 6% in a week? Floor created? Or clear collision course with the United States of America, which has expended a vast amount of political capital on a rapprochement with the kingdom. His Royal Highness, in the press conference, in the conversation, very reticent to get drawn into the response on the issues from the White House. But of course, the red headline on the Bloomberg terminal went to the Russians, because it's about the price caps which are coming. The known unknowns, you know I like to quote Donald Rumsfeld, one day I'll get the sequence right. But there are a series of known unknowns and the unknown knowns. And the unknown knowns are the impact of those price caps. Let's listen to Novak.
Such actions, as we're seeing, creates, i.e. the price cap, creates a very bad precedent, and will primarily hit the ones who are actually doing it and the ones who are implementing it. We know, and history has a countless number of examples of when market interference, especially with the mechanism of price controls, can only lead to a deficit of a certain good. Is that this mechanism is unacceptable to Russia, and if it is implemented, we are not going to supply countries which join this mechanism.
These price caps are going to interfere with Russian supply, and this is the whole point. We don't know exactly the framework of these cuts, but Danny, it is going to mean a near-term potential drop in production, a deficit. That's what these price caps can potentially deliver. And then I push the Saudi prince on, what are you going to fill the gap? Are you going to fill the gap that's potentially created? Because here you are cutting by 2 million barrels a day into a market. We also had a conversation, Danny, about the global macro backdrop. That's how OPEC Plus presented these cuts. But the bottom line is they're worried about the dollar, they're worried about inflation, and they're also worried about central banks going hell for leather to tame inflation at any cost to growth. Danny.
Well, of course, a stronger dollar also just means that for many folks, including a price cut, higher oil is going to be even more painful. And Manus, look, such good interviews yesterday. I don't think we can say it enough. Really on top of everything. And we had Saudi's top oil official saying that U.S.-led plans for a price cap on Russian exports only adds to market uncertainty.
Yes, there, again, fragility, uncertainty. The language used in the press conference was about prudence, it was about being preemptive. This is why they were taking this action. But it's prepare for more volatility. And as I say, there was a salutary warning. Shameless plug. Go and have a look at Twitter. The whole interview is there. But it's about the volatility that's coming from these macro factors. Let's just tune in for a piece, a soupçon of His Royal Highness.
I don't want people to think that this is a one-way street. In this case, no, it's a variety of convoluting uncertainties, and they could go astray altogether, and to the positive side or to the negative side, or it could be a combination.
We went on to discuss whether Saudi would do as they've done on many occasions, take the higher ground, the bigger role, and perhaps consider unilateral cuts, which they've done in the past if needed, or unilateral adds. He wouldn't be drawn on that exactly, but you can certainly talk about a toolkit which is far from expanded. It was a packed house. It was great to be back in Vienna. It was great to be back in the bunker, so to speak. But there's a whole host of issues around this. And my takeaway is this: we're set for a heck of a bumpy ride on vol and demand, on the supply, on the price cap. And it's very clear they could be ouching like hell if NOPEC really comes to life from Congress. Danny.
Never too far from an ouching like hell quote, Manus. Great stuff as always. Stay warm. You're going to be back with us again in about 30 minutes time, so stay tuned for that. We're going to listen to more of Manus's great interviews. Manus, thanks as always. Now, Prague today will play host to an extraordinary summit of European leaders and other regional players. It's the first ever European political community meeting, and it comes as the EU backed a new package of sanctions on Russia. For more on this, let's get to Bloomberg's Luba Pronina in Brussels. So, Luba, yesterday, European Commission President Ursula von der Leyen reached out to the EU leaders, basically a plan to tackle the soaring gas prices. What did that plan involve?
Indeed, the president of the European Commission reached out to the leaders of 27 member states in the European Union who are meeting in Prague this week to talk about what can be done to address the soaring gas prices. And she wrote a letter yesterday addressing the European leaders where she laid out a plan what can be done. And there are a few tracks. Obviously, central to this is connection of gas prices and electricity prices. And what the EU is ready to discuss is the introduction of a temporary cap on the prices of gas that is used to generate electricity. So this will be a focus of discussion, but also around that, while this temporary cap is in place, the European Union will work on a new benchmark for gas that will complement the existing one, the TTF title transfer facility, that Ursula von der Leyen says is not reflecting the actual situation in the gas markets today. So the European Union will work on that. Also parallel to that, the EU is planning to take action to dampen the price for gas that is imported from other countries. And it's going to talk to its trusted parties like the USA and Norway.
Yeah, I mean, to be fair, we've fallen about 50% from the peak of Dutch front month gas futures. So perhaps there was an element there of, as you say, perhaps it wasn't really reflecting fair value, just speculation. Lubov, thank you so much. That's Bloomberg's Lubov Pronina in Brussels, capping off the energy conversation for us. Of course, this all feeds in to the Fed, to inflation. And Fed officials, they've been weighing in on the prospects, or really more accurately, the lack of prospects for U.S. rate cut next year. Both Mary Daly and Raphael Bostic are the latest to bang on the drum on the need to keep tighter policy in place. Let's bring in senior Asia economy reporter Michelle Jamrisco. I mean, Michelle, it didn't really take much for this pivot party noise to die down.
No, that's right, Danny. I mean, this debate is as hot as ever. Of course, you've got the markets and other Fed watchers on one side looking at that gloom and doom in the global economy, rising recession risks. You saw the RBA earlier this week with a smaller than expected rate hike, that dovish turn that we saw. But none of that has changed it for the Fed. They're still looking at data that they think is red hot inflation that they need to continue fighting in the face of jobs data that maybe has shown a little bit less tight labor market with the job openings earlier earlier this week, as well as jobs day data on Friday that should show at least a little slowing in job growth. But what they're saying is not so fast. To quote Atlanta Fed's Raphael Bostic, they don't see their rate hikes damaging the economy irrevocably yet, and they want to continue with that because they're not seeing prices come down convincingly enough. And of course, the OPEC news, not a comfortable development for either the White House nor the Fed, but it certainly bolsters the Fed's case to continue those rate hikes for now. Mary Daly setting a very high bar for relenting on the 75 basis point hike. So all signs point to the fact that they should have a fourth straight meeting, if it were decided today, a fourth straight meeting where they're doing 75 basis point hikes, and that will come November 1st to 2nd.
And I wonder how this the ramifications of this for more global central banks, Michelle. We get the ECB minutes today of their September meeting. How does an aggressive Fed feed into what we're expecting from the ECB?
Well, it's certainly rattling for ECB and the likes of central banks everywhere. I mean, they have to kind of take into account, especially the more externally facing economies like Australia we saw earlier this week. They have to take into account the impact of the stronger dollar and all this Fed speak and the commitment that the Fed is projecting to keep those rate hikes up. Certainly paired with that, and what's spooking the markets, I think, a lot is the growing recession risk, of course. And, the European economy seems to be a bit worse off, I should say, than the U.S. economy at this juncture. So anything that kind of worsens that growth side while inflation is not improving in any of these places, or at least markedly so, will kind of trigger some further action and some complicated decisions on the part of other central banks.
Okay, Michelle, thank you for walking us through it all. That's Bloomberg senior Asia economy reporter Michelle Jamrisco. Coming up on the program, more Fed speakers pour cold water on hopes of an early dovish.
We have a really good life in Chicago.
He's just going to see his cousins. Even you left Mississippi, Mama.
Most of us would not know who Emmett Till was if it weren't for Mamie.
Can you bring Emmett's black suit? It's how he'd like to be seen.
Bo's in no kind of shape to be seen by him.
He's in just the right shape.
We're making movies not just by us, but for us.
There will be no physical violence against black people on screen. We're going to begin and end in a place of joy.
Till, rated PG-13.
Dovish pivot. We're going to talk market strategy with Wtdta Gupta, head of equity strategy at Emirates NBD. This is Bloomberg.
Why does everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrell. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg.
I don't see that happening at all. I see us as raising to a level that we believe is restrictive enough to bring inflation down, and then holding it there until we see inflation truly get close to 2% and demonstrate that price stability is restored.
I'd like to reach a point where policy is moderately restrictive, somewhere between 4 and 4.5% by the end of this year, and then hold at that level and see how the economy and prices react.
FOMC members Mary Daly and Raphael Bostic echoing that the Fed is unlikely to cut rates next year. We did see equities fall slightly after a pretty big gain for the first 2 days of October. Let's bring in Anita Gupta, head of equity strategy at Emirates NBD, to the conversation. Anita, one of the best starts for this equity market to an October since the 1930s. What are we witnessing here? Just a little bit of start of the month reshuffling, or is it something more sustainable?
Yeah, good morning, Danny. And what we see here is after 3 quarters of sequential negative returns for equities, what investors and what markets were hoping for was a little bit of a Fed pivot. Now, that's not our view at this point. And with the inflation numbers, with energy prices still staying high, we don't think that's going to happen. So what you saw was a few rays of sunlight, but it's not going to be a full season of sunlight. We still have very sticky inflation with the Fed convinced on its tightening path to curb inflation, and that feeds into corporate margins when you have higher rates.
So the storm clouds remain, if I can take the glass half empty version of what you just said, Anita. You mentioned the energy picture and what that will mean for inflation. Well, yesterday, we of course get OPEC Plus saying that they're going to slash output by 2 million barrels per day. We have seen break-evens decline pretty significantly from their peak. Anita, I believe we have this chart, and they didn't tick up too much after yesterday's OPEC Plus decision. How much is OPEC challenging the inflation picture, essentially challenging the Fed, as Jeff Curry over at Goldman Sachs put it?
Very definitely you've got a supply-demand situation, in addition to the fact that OPEC economies are looking at balancing their budgets. So, and in fact, as we've seen this whole morning, we have seen other analysts come in. It's not really a 2 million barrels a day cut. It'll relate to around about 1 million, 1.1 barrels per day. So, energy prices were expected to stay higher. I don't think that this cut is the only instrumental factor in keeping those energy prices higher. So inflation, yes, is driven a large part by energy prices, and that is a sticky part of the inflation that's not going away. Shelter, yes, we are seeing a few green shoots, and again, this is a phenomena across 80% of the world. The sticky inflation driven by both higher rents, higher energy prices, higher food. And the Fed is definitely on a continued tightening path, but so are a number of other central banks.
What if, Anita, the Fed doesn't pivot because inflation is conquered? What if they pivot because we have dysfunction in this market, that liquidity issues continue to snowball, they continue to worsen, and the Fed needs to pull a BOE of sorts and step in and help this market? What is the possibility or the probability that that is how a Fed pivot unfolds?
That's always a possibility, Danny. I don't think that, this is a market or a scenario where everything is absolutely definitive. The market is driven by data, so is the Fed driven by data. We are seeing on the earnings front, we have seen companies give guidance as to lower, in the quarters going forward, whether it's FedEx, whether it's Apple, whether it's Facebook cutting employees. So from the ground level, you are seeing corporates coming up with lower expectations for the quarters ahead. Now, that is where your economic growth comes from. We're also looking at the monetary supply. We're looking also at a very much stronger dollar. So would the Fed have to step in some point like the Bank of England? I think it's way too early to say anything. I think we just have to wait for data to see where economic growth goes, where the standards of living, that's very important in terms of, U.S. recession especially, and how that plays out into this coming winter.
I'm sure this is going to be a question asked over and over again this earnings season, Anita, so might as well kick it off now. In terms of an earnings recession, the worst that we might see from earnings, how much is it priced into this equity market?
Equity markets are always leading earnings. So the 25% fall in equities we saw in the first 3 quarters were reflective of expected slower earnings growth. We are looking at, from a FactSet consensus analyst estimate, about a 2.9% earnings growth for Q3. That's the expectation. But surprisingly, for Q4, they're again looking at analysts at a 4% earnings growth. That's a year on year. And for 2023, it's around 6 to 7%. Now, that's where we think we are going to probably see lower earnings growth, maybe even flat. The expectations are way too high for 2023. You're definitely going to see the impact on corporate margins from the higher inflation numbers. We've seen wage growth that stays sticky. So it's not going to be as positive a year in 2023 as 2022. And we are coming off a very high base in 2021. And yet we are seeing earnings growth in 2022.
Okay, Anita, just out of time. Thank you so much for joining us this morning. Anita Gupta, Head of Equity Strategy at Emirates NBD. Coming up, markets take a breather after a relief rally. We're going to bring you the latest on this equity rally, running out of steam, picking up again in the futures market. We got the twists and turns for you. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
Welcome back to Daybreak Europe. Happy Thursday. So this really interesting debate unfolded in the equity market yesterday because at one point U.S. stocks were down some 1.8%, but they had this massive turnaround late in the day to end basically unchanged, just a loss of about 0.2%. You had Wells Fargo, the analyst over there, saying, oh, someone took out this big options market bet, and that caused the dealer to take the other side. Things rallied. You have Susquehanna saying it's because of a retreat in the dollar. Regardless, the impact was a rally that started late in the day yesterday in the U.S. and has continued into this future session. It's also continued in a big way to the European future session because Europe closed down pretty negatively when the U.S. had started to rally. So what are we seeing this morning? We're seeing a gain of 1 1/3% for Euro Stoxx 50 futures. If it holds this, A pretty solid week for equities, which just not that long ago were plumbing the November lows of last year. Well, coming up, oil prices extend their rally after an OPEC cut. More on that next. This is Bloomberg.
How much of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan's society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
Welcome
to Bloomberg, the lineup.
Good morning. This is Bloomberg Daybreak Europe. I'm Danny Berger in London. These are the stories that set your agenda. Biden rebuked. The White House criticizes OPEC Plus for its decision to cut output, calling the move short-sighted. Crude climbs for a fourth straight day.
A variety of convoluting uncertainties, and they could go astray altogether, and to the positive side or to the negative side, or it could be a combination.
Energy discord as OPEC Plus unites. EU Chief Ursula von der Leyen calls for limits on gas prices after the bloc acts on oil. Moscow says the move will backfire.
Price cap creates a very bad precedent and will primarily hit the ones who are actually doing it and the ones who are implementing it.
And pivot? What pivot? Fed officials continue to pour cold water on prospects for a quick policy turn. Mary Daly tells Bloomberg there's a high bar for any change. Let's stick on that oil story. What's been described as a battle between OPEC Plus and the West. We are seeing crude extend a 3-day rally. It was an action-packed 24 hours in this oil market. Of course, we had OPEC Plus agreeing to cut its output by the most in 2 years. That earned a rebuke from the White House. The EU, meanwhile, agreed to a plan by the EU to impose price caps on Russian oil exports. Well, let's head back to Vienna, where Bloomberg's Manis Cranny has been braving the cold, standing by. Manis, I believe it's called pathetic fallacy when the weather matches the mood. Chilly in Vienna there, chilly when it comes to the relations between the West and OPEC Plus.
Just think of the political capital that the White House has expended in extending its rapprochement to the House of Saud. I'll return to that in a moment, but let me just float that out there. The other side of this trade and the OPEC Plus, the plus relationship, is Russia. Novak, Deputy Prime Minister, on the ground here in Europe to talk to his, I suppose, his cohort of like-minded people, which is how do you re-grasp the nettle in a market when you're dealing with a series of literally unknowns? How will the price cap work? What impact will it have? The red headline on the Bloomberg terminal was very clear from Alexander Novak, Deputy Prime Minister of Russia. Production will drop. My question in the back of my mind, who's going to fill the gap? But let's listen to Novak's first take on caps.
Indeed, there have been two important decisions taken today. One, you have already mentioned, and that is the decision on cutting quotas by all countries present and by all countries in the group. But the second decision, which is just as important as the first one, is actually the extension of the Declaration of Cooperation, because it was scheduled to expire at the end of 22, but now it has been agreed that it will be extended until the end of 2023, which gives the market significantly more certainty and significantly more predictability. And that's why a decision was taken to balance the market out by these cuts, by cuts versus quotas of August. And especially this is very important ahead of the winter season, when we would also see the seasonal decline in demand by 2.5 to 3 million barrels. And this decision, which has been made today, helps the market to balance it out. I think it's a very weighted decision and a timely one.
Let's look towards February 2023. You will have more sanctions, we assume. You will potentially have a price cap. Can you tell me with a surety what your production in February 2023 will be? You say 93% for 2023, but is that the worst case scenario by February with more sanctions and a price cap?
Such actions, as we're seeing, creates, i.e. the price cap, creates a very bad precedent, and will primarily hit the ones who are actually doing it and the ones who are implementing it. We know, and history has a countless number of examples of when market interference, especially with the mechanism of price controls, can only lead to a deficit of a certain good. This mechanism is unacceptable to Russia, and if it is implemented, we are not going to supply countries which join this mechanism.
So, Danny, you know, the whole essence of price caps from the EU are going to lead to a deficit. Who's going to fill that gap? That is the big question as OPEC Plus goes into cutting mode. I think a number of other messages came through. It's about the extension of the cooperation agreement through next year. So that shows you there's a solidarity between OPEC and OPEC Plus that is not going to dissipate. I challenged Novak in terms of will you cut the gas flow off through the Ukraine. I pushed him and pushed him. Go listen to the interview. Again, it was about delivering the standard kind of answers, but was it on the table? It's certainly not top of their agenda. That was the one upside that I took away from it. But as for the House of Saud, preemptive, proactive, that's what His Royal Highness, that was the message he wanted to convey.
But Manis, I mean, you teased me, you teased our viewers with the political drama. Take us into it. What has been unfolding since this decision?
Yeah. I was sitting in the bunker, sort of in there last night, and then suddenly this thing lit up. It's attached to my hand, as you know. I mean, I can't go anywhere without it. And it was the Jake Sullivan, you know, the president is unhappy. Biden sees these cuts as unnecessary. But the Jake Sullivan memo is incredibly interesting because I think it brings to play, you know, my favorite word, trifecta. So what it brings into play, there's a kid going to school. He's not going to get there. Go on. What you've got is the risk of exports being stymied. You have the risk of NOPEC, which is the ability, if it goes through Congress, to sue a sovereign nation who's potentially a part of OPEC. That's the real issue at play. And the third and more important issue is, of course, the error of the president, the unnecessariness of these cuts. So the White House not only were panicking yesterday, according to Rapid in Energy, but we're now seeing really a very, very fierce pushback by the White House. And I just wonder where this will escalate to, or can it be de-escalated? Let's listen to His Royal Highness Prince Abdulaziz bin Salman on his take on yesterday's proceedings.
We wanted to give the market a clear direction, a clear input. That's why we extended the agreement to end of 23. But we still have the same tools in our kit, you know. Guidance to the market is crucial because without guidance, people would not invest, would not feel safe that they could invest. However, we still have the tools in our kit. We still, we reduced the amount of meeting, we reduced the amount of overall expectations of doing something, but we still maintain the same flexibility. We still have every 2 months we will have a GMMC. That GMMC is warranted the authority to have more than a meeting in every 2 months. It also was given the authority to call for a conference meeting if necessity dictates that.
Part of the toolkit, and the Kingdom has often done this, which is led from the front and gone with voluntary cuts or ads to do the right thing to right the market. Did you consider a voluntary additional cut for Saudi?
Well, at this time now, there is no requirement for it. I think amongst us, we sort out a good deal. It certainly, we had to be very practical, given the situation prevailing in some countries that are not able to produce their allocated voluntary volumes. And because of that, we elected to go for a bigger number, but in the final analysis, it will be a smaller number, but certainly a significant number, and therefore we feel it is sufficient for now.
I think it's very clear His Royal Highness sees two-way risk and a preparedness. The word in the news conference or the press conference was tweak. You know, he pushed back. I said this is the first of a series of jumbo cuts, and he really wanted to push back on that narrative with me as we sat down. Danny.
Manis, I got to wonder, Goldman Sachs, they had this note out. I'm sure you saw too, Jeff Curry and team labeling this OPEC Plus takes on the Fed. I mean, if we have oil at $100 a barrel or higher because of this cut, what does that mean for the Fed, for inflation, for this macro environment we're in?
Shall we go for a shameless plug? Ooh, why not?
Let's do it.
If you go and you listen to the whole interview on my Twitter account, if you go and you listen to the whole interview on my Twitter or on Bloomberg.com, let's go with the global brand. It is very, very clear, which is it is a risk. It's this balancing act. His Royal Highness makes the point. Look, I said, surely you're just going to fuel inflation. We're up 9% in 3 days. Everything the central banks have been trying to undo. And his point to me was, well, the central bank policies have been going after inflation at the cost, any cost, to growth. And this is the conundrum, isn't it? You know, you add 10% to the oil prices, you refuel the inflation narrative. But his point to me is that central banks, and many would say from a macro point of view, are absolutely correct. They will not stop until the job is done in stymieing inflation. And with that in mind, there's a cost to growth, and that is a huge risk. Along with the dollar, strength of the dollar, macro rates, all played into this conversation.
Manis, I just want to leave it off on this. I know you're probably feeling the cold, especially from your Dubai. But, you know, Mohammed, our producer, tells me it's going to be up to 23 degrees there in Vienna. You're basically in summer weather, Manis. You can ditch the scarf.
You mean I won't get to wear the coat? You mean I won't get to wear the coat and the scarf all day?
Honestly, it's too fashionable. Keep it on. It's fine. It's worth it. Such great stuff. Let me just plug it for you again. Go to Manis's Twitter. Go to Bloomberg.com. Watch the interviews. Really great stuff. Huge implications. Manis, thanks so much. Looking forward to you back in the driver's seat here on Bloomberg Daybreak. Manis Kranis there in Vienna. All right, let's get back to these markets, get a check. Let's start with that oil market because we saw all of the implications, all of the fallout from this. We saw oil, it's basically hanging tight. But again, we've seen a monster rally of 6.5%. So perhaps not unsurprising, we're hanging around $93.50 a barrel. 10-year yields, those did perk up yesterday in response to this inflationary output of higher oil prices. We were at about 3.6% yesterday, so we stand at 3.7% and some change, though we are looking at a drop of about 2 basis points. Bloomberg dollar spot, that's weaker this morning. That's allowing equities to rally. Now, we are doing a little bit of repositioning ahead of a Friday NFP report. That payrolls report going to be pretty consequential for the Fed. Our cracks showing in this labor market. Are they going to have to keep hiking rates until there are cracks? So we see a rally continuing in U.S. futures and European futures. I don't have them here for you at the moment, but European futures up more than 1%. There we go. TV magic. European futures up 1.4%. Well, coming up, we're going to talk Twitter. Elon Musk's deposition in the Twitter lawsuit. It appears to be on ice. All the details for you next. This is Bloomberg.
recently, cryptocurrencies have been very popular. And if a client came to you and said, look, I'd like some cryptocurrencies in my portfolio, what would you say?
Oh, we've actually been really deep into crypto, deep into learning about blockchain, and all of the new businesses. You know, I would characterize this as crypto learners. You know, we have made a series of toehold investments on behalf of our clients, both in some of the currency baskets as well as with some venture firms that are investing primarily in the crypto area. I think it has the potential to be completely game-changing, but it is still such the Wild West, and it's so uncertain. But it has the potential to completely upend everything.
Elon Musk and Twitter are said to have agreed to postpone the billionaire's deposition that was set to take place later today. It follows Musk's dramatic U-turn to revive his $44 billion offer for the social media platform. We're joined now by Richard Windsor, founder of Radio Free Mobile, to get into this. Richard, I want to start here. Musk made so much noise about trying to get out of this deal, whether it be bots or whistleblowers. What do you make of him all of a sudden just surrendering unconditionally?
Well, I think what's happened is, as happens in many legal cases, is that the initial, something has happened that has materially weakened his negotiating position, and he's either come to the conclusion or been advised that he's going to lose, and the best option for him now is just to go through on the deal that he originally made. That's what I suspect has actually happened. I don't think particularly he's had a change of heart. I think he's always wanted to buy it. It was more about the fact that his timing wasn't great, because the minute he bid 44 billion, the bottom fell out of the technology market, and he thought maybe I should have paid less.
Well, to that point, so in the letter that Musk's lawyers sent to, filed with the SEC, sent to the team at Twitter, so two things jumped out at me. Really short letter, but one of them basically saying that him buying the company, it's contingent on two things. I want to start with one of them. One of them is that provided the Delaware Chancellery Court enter an immediate stay of the action and adjourn the trial and all other proceedings related to closing the order. So kind of going to what you're saying, before the court case, closing this thing up, so he does buy it. But I wonder, is there a risk, Richard, in which they close the deal, this stops so the purchase can continue, but then he doesn't go through with it, if that makes sense? So trial stops and then Musk backs out. Is that a risk here?
This is an indication of how little trust there is between the two sides, because obviously Twitter think that's exactly what he's trying to do, which is why they are trying to batten down or close every potential exit for him, by which he could somehow wiggle out of paying the price that he agreed to pay. So I think that's really what's going on here. I think the fact that he has, pretty much uncategorically caved in to the demands that he buys the company for 44 billion kind of indicates how weak his current legal position is. And frankly, I'm not surprised. I always thought he was going to lose the case.
Yeah, you have been saying that for some time, Richard, so you can take a victory lap with us. That's fine. I want to bring you to the other thing, though, that was in that same sentence that I just showed you. The other thing closing this deal is predicated on. He says that it's predicated on pending receipt of proceeds of the debt financing. Richard, this is a bond market, a high-yield bond market, which has essentially been frozen. Banks really struggling to offload LBO debt. What's the likelihood that Morgan Stanley and friends are able to actually put together a debt package for him? Is this a big risk to the deal going through?
I don't think so. I think the problem he's going to have is that the deal is going to be much more expensive. If he'd put it together 6 months ago, or 5 months ago, when he originally announced it, interest rates were considerably lower and the market was considerably more willing to take on risk. And so from that perspective, he could have got it away more easily and at a lower price. Now, he's going to have to pay a high price. I think that, there's plenty of cash out there willing to be deployed. It's just the willingness of that cash to pay high valuations or receive a low yield has gone away. And so basically, I think the deal will get done. It's just going to be a lot more expensive than it was.
I mean, how much appetite is there going to be for this, considering we just had starting since late April when he backed out of the deal, or whenever that was, of course, he agreed to the deal in April. We've just had Musk nonstop disparaging Twitter. I mean, who's going to want to, A, buy the debt, or B, join Elon Musk in committing equity to this?
Well, I mean, let's be fair to Twitter. I mean, Twitter is utterly dominant in its space. It monetizes quite effectively what it does. There has been for 10 years an unfulfilled opportunity for Twitter to expand its reach outside of just that little space that it does, and it has a highly engaged user base. So there is potential value there. The question is that, Twitter's management for a decade have failed to expand it effectively. Can Mr. Musk pull it off?
I got to bring you a quote from John McClane. I just love this. He's a manager at Brandywine, saying it's similar to a vegetarian going to a steakhouse, very limited appetite. So he might disagree with you that anyone wants it. But Richard, to that point of Twitter, the successfulness of the app, I was asking you this in the break. I mean, what's going on with Elon Musk and the Everything app? How does that apply to Twitter? What would it mean? Does it change Twitter? Does it compete with Twitter? I don't totally understand.
Okay, so the essential problem that Mr. Musk has is that he's paying, according to some people, including myself, probably 3 times more than what Twitter is worth. So somehow he's got to prove or create value inside Twitter that would, justify the $54.20. Now, one of the ways one could do that is to expand the appeal of Twitter. There's much more to the digital ecosystem than just microblogging. There's video, there's social networking, there's instant messaging, there's news, there's podcasts. There's all kinds of things that you could do that basically would mean Twitter's users spend more time engaged within the Twitter property, and that would increase the value. The idea behind the super app is a bit like Tencent's WeChat. We know WeChat started off as, a bit like WhatsApp or Telegram. And now you can do everything on it. You can, in China, you can buy train tickets, your cinema tickets, you can pay people and so on and so forth. The idea, I think, behind the super app is to do exactly that. And quite frankly, if he's ever going to justify a $54 price tag, this is exactly what he has to do.
Okay, Richard, I'm afraid we're going to have to leave it there. Thank you so much for joining us this morning and waking up early. Richard Windsor, there, founder of Radio Free Mobile. Coming up, investors are offloading Italian bonds at the fastest pace since the pandemic first struck. That all follows a warning from Moody's about the nation's finances. We'll get more on that story next. This is Bloomberg.
Why does everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Let's talk about Italian bond risks, and to do that, let's bring in Bloomberg's market editor, Wtdta. Valerie, you flagged the story to me this morning, and so let's go over some of the risks that perhaps are leading to the drama. So you flagged to me we had ECB's Fabio Panetta. There were hopes that perhaps he'd join as the finance chief of Italy. That's not happening. We also had Moody's warning as well on their finances.
Yeah, exactly. And then thirdly, we had the bi-monthly release of the PEPP holdings from the ECB. Now, these showed reduced support for BTPs over the month of August and September. Now, give you some background. We know that PEP purchases ended in March of this year, but there is flexibility in how they reinvest the dividends until the end of March 2024. Sorry, the end of 2024.
Right.
Now, you would think that in a period of volatility, which we had this summer, where Italian yields rose 150 basis points, maybe they would use that kind of flexibility that was given to them to support BTPs, to support their bond market. But that was clearly not the case.
And that's just, this most recent month, right? Before that, they had been helping Italy out.
Exactly.
To some degree, right?
Yes, they had been.
So this is a reversal then.
Yeah. So they had been, you could say, diverting funds away from Northern European countries and putting a bit more into reinvesting in Southern European countries.
So, okay, yesterday, not tomorrow, my days are mixed up. Yesterday, we have the confluence of these risks. You have Panetta not joining, you have Moody's warning on the new government, and then the PEP holdings are lower, and then we get this blowout in BTPs. Walk me through that.
I want to show you on the next chart how pivotal this was for BTPs.
Please.
So the 10-year yield jumped nearly 30 basis points, the largest jump since the beginning of the pandemic. And it's the second largest jump since March 12th, 2020.
Oh, man.
That was after Lagarde said her famous quotes, "I'm not here to close spreads." So it was quite a big move. And I think a lot of this was kind of overshadowed by the dealings with OPEC yesterday, as you and Manis have been talking about. But this move, it's large. 10-year yields in Italy are nearing 4.5%. Debt to GDP metrics with this new government coming into place are in focus. And then today at 12:30, we have the ECB minutes. Investors are going to be highly attuned to any comments on QT discussions within the central bank. Maybe something they could roll out before the end of the year.
But I mean, they do have this program, the TPI program, to help in these cases. I mean, could they just be transitioning from PEP help to that program?
Look, it's still very vague, the metrics by which they would activate this TPI program, but one of them is they need to see a sustainable debt metrics within a country.
That doesn't
and with
look,
this new government
yes, exactly.
in Italy, it's pulling this all under huge focus now for Italy's bond market.
Exactly. A big old question mark put on this bond market. Valerie, thanks so much for walking us through that. Wtdta there, our markets editor. Well, that's it for Bloomberg Daybreak. Markets is up next. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrell. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg.
Good morning. Welcome to Bloomberg Markets Europe. I'm Anna Edwards, live in London. The cash trade is just less than an hour away. Here are your top headlines. Biden rebuke. The White House criticizes OPEC Plus for its decision to cut output, calling the move short-sighted. Crude trades flat after 3 days of gains. Energy discord as OPEC Plus unites. EU Chief Ursula von der Leyen tries to rally the bloc behind a limit on gas prices after taking action on oil. European leaders meet in Prague today. Plus, pivot. What pivot? Fed officials continue to pour cold water on prospects for a quick policy turn. Mary Daly tells Bloomberg there's a high bar for any change. Good morning, everybody. Welcome to the programme. Let's get straight to some breaking news, shall we? Or, in fact, we are waiting for some breaking news on the German economy. Now, here it is. Factory orders falling by 4.1% year-on-year. The estimate was for a drop of 5.5%. The August factory orders number then, month-on-month, falling 2.4%. The estimate was for a drop of 0.7%. So a bit of conflict, perhaps, between what is being signalled by that month-on-month versus year-on-year number. But if we focus on the month-on-month, a drop of 2.4% is much bigger than the estimate of a less than 1% drop. This is a volatile data set. It is just 1 month's worth of data, but the number last month was down by more than 1%. And, of course, there's a lot of concern going into the winter about the state of German manufacturing and the factory sector. And so we'll certainly get to a conversation about that with Carsten Bresky, who joins us a little bit later on in the programme. But some perhaps gloomy news coming through on where we are on the German economy. The euro trading at 0.9920. So actually gaining 0.4% in this morning's session. Now, we're just under an hour away from the start of cash equity trading here in Europe. Let's have a look at the futures picture. We've got futures pointing higher, actually, and quite substantially so here in Europe. Just to recap, we were down in the European session by more than 1% on Stoxx 50. So perhaps we have a little bit of catching up to do, because the US session went from a negative picture to actually reclaiming some of that ground. A later in the day, or certainly from lunchtime onwards, rally in the United States. And that means that there's a little bit of a gap to be closed by the European equity markets. On the US side of things, though, that rally looks to continue. So US futures point higher by 0.5% on E-minis. NASDAQ futures up by 0.7%. So the US erased its losses in session, despite the fact that we saw higher energy prices for a third day because of those moves at OPEC Plus. The energy names helped to drive some of that. But if we look at the GMM, you can see we're picking up that fairly bullish theme when it comes to equity trading in Asia. The Kospi, the Nikkei, the Sensex, all trading higher. Slightly strangely bullish, perhaps, given the dynamics we're dealing with at the moment. Perhaps the way that the oil price is playing out in markets, perhaps there are different ways to interpret that right now. We'll get into that conversation a little bit later on. But the markets, safe to say, in the short term, feeling fairly bullish despite higher energy prices of late. So that's where we are on the GMM. Let's talk about those oil prices. Oil prices are trading higher this morning, or at least have been, pretty flat on Brent right now. After an action-packed 24 hours, OPEC Plus agreed to cut its collective output by 2 million barrels per day, the most in 2 years. Although the move may not hit oil supply by quite that much, it does have implications in the energy war between Washington and Moscow that Saudi Arabia is willing to help Putin rather than Biden.
We have so many uncertainties.
Today helps the market to balance it out. I think it's a very weighted decision and a timely one.
Well, we were disappointed that OPEC made this decision. As the president mentioned, we think it's unnecessary.
I don't want people to think that this is a one-way street.
Let's head to Vienna, where Bloomberg's Manus Granny is standing by. Manus, let's start with the rally in prices then, because this has been a multi-day trend, sort of in anticipation of what was going to happen where you are in Vienna. So we've seen this rally in prices. Some people, though, questioning just how much of a cut we'll actually see, though, and therefore how much of a sustained impulse we see on prices.
Good morning, Anna. You're absolutely correct. You know, if we sort of stand back for a moment and go 2 million, the blockbuster headline, but of course, it's a paper cut, but it's about direction. It's about clarity and confidence. That's what they wanted to intimate in that House of Central Banking behind me for oil. So it was about the messaging. His Royal Highness Prince Abdulaziz bin Salman talking about prudence, talking about preemptive moves. So that was about the messaging. I asked him, was this the first of a series of jumbo cuts that could come from the Central Bank of Oil? And he sort of played that down. So this is about delivering confidence and continuity, but my gosh, we're in for a level of conflict, aren't we, between here and the White House, between Riyadh, Moscow, along with a number of other states and the US. So, Anna, there's a number of issues here. For the Central Bank of Oil, I think it was about the messaging of ready to do more. They painted it up as being the global economic situation. But politics, it really does matter, Anna. And, of course, the price caps are critically important as well. And this is what Alexander Novak put into context: the risk to the market and supply from Russia on caps.
Such actions, as we're seeing, creates, i.e. the price cap, creates a very bad precedent, and will primarily hit the ones who are actually doing it and the ones who are implementing it. We know, and history has a countless number of examples of when market interference, especially with the mechanism of price controls, can only lead to a deficit of a certain good. That this mechanism is unacceptable to Russia, and if it is implemented, we are not going to supply countries which join this mechanism.
Alexander Novak there talking about the uncertainty. I'm just looking at the oil brief today, and again, the lack of details, the lack of clarity. Not my words, but those of Prince Abdulaziz bin Salman. But Anna, my gosh, we're in for a bumpy ride with the White House, aren't we?
Yeah, absolutely. Let's turn to that next then, to geopolitics of this, Manus. Saudi Arabia's top oil official is saying that the US-led plans for a price cap on Russian exports, that was something that added to the market's uncertainty. So how is the geopolitics of this playing out?
I was sitting in the bunker last night and suddenly pop, pop, pop. It was, you know, it was Jake Sullivan's memo from the White House. The headline on the Bloomberg, which was, Biden sees this cut as unnecessary. He wanted to see more detail. Then Jake Sullivan, gut-punching stuff, which is, you know, this is a disappointment, and putting out there on the table the SPR, the Special Petroleum Reserve release. There would be more of that to come. That sort of, it's almost like a yin and a yang. You know, you want to cut by 2 million? I'll see you and raise you. I've got an SPR, and I will release more if I have to. But the much, much more potent part of this is the prospect of NOPEC, which is the ability of Congress to turn on the members of OPEC. His Royal Highness likes to keep the market ouching like hell. Of course, NOPEC could cause a bit of an ouch for the whole of OPEC. Let's listen in to what His Royal Highness had to say about the prospect of volatility in this market and his take on yesterday's proceedings.
I don't want people to think that this is a one-way street. In this case, no, it's a variety of convoluting uncertainties, and they could go astray altogether. into the positive side or to the negative side, or it could be a combination.
And as the central banker of oil, of course we got into the weeds about, you know, they are raising rates. I said, you're fueling the inflation debate again. You're refueling the inflation narrative. And he said, Manus, he said, central banks are so focused on taming inflation, they are prepared to raise rates and almost at growth at any cost, you know, hitting growth at any cost. So the strength of the dollar, Federal Reserve, MPC, not BOJ, central banks raising rates, it all came into play in that conversation. Anna.
Yeah, really interesting. The central bank of oil up against the more conventional central banks there. Manus, thank you very much. Manus Cranny joining us there from Vienna with the latest on the complexities and the developments around oil. Let us get a Bloomberg First Word News update. Alice Atkins joins us with the latest on our top stories. Good morning, Alice.
Morning, Anna. Ursula von der Leyen is proposing that the EU intervenes in the gas market to cap rising costs. The Commission President's plan includes a temporary price limit on the Dutch benchmark gas price, which is used for all gas traded in Europe. Von der Leyen contends the price no longer reflects the bloc's energy reality and the rapidly shrinking share of gas from Russia. The World Trade Organization says global trade will slow next year as major economies face strong headwinds. The WTO forecasts global goods trade will now grow by 1% next year, a big revision on its previous estimate of 3.4%. It blames a cocktail of factors, including rising prices, restricted energy supplies, and growing US-China tensions. North Korea has fired two suspected short-range ballistic missiles towards waters where a US aircraft carrier had been deployed, making a total of 10 launches in less than 2 weeks. That's one of its biggest test barrages under leader Kim Jong-un. The firings came shortly after Pyongyang condemned the Biden administration for escalating tensions. And King Charles III is expected to be crowned on June the 3rd next year in a ceremony at Westminster Abbey. Bloomberg has learned that British officials are converging on that date, although talks are still ongoing. The coronation, almost 70 years after his mother was crowned, will form the centrepiece of days of celebration to mark the beginning of the monarch's reign. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna?
Alice, thanks very much. Alice Atkins in London. Now, coming up, it's been a wild first month for Liz Truss's government and for UK assets, with £300 billion wiped from the combined value of the nation's stock and bond markets. We'll have more on the investment case around the UK later. Up next, more Fed speakers pour cold water on hopes of an early dovish pivot. We'll discuss that and plenty more with Carsten Bresky, who joins us from ING shortly. If you have any questions for our guests, then please do send them to us. IB plus TV Go. That's the function to use on your Bloomberg. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the US shaped the 20th.
I'd like to reach a point where policy is moderately restrictive, somewhere between 4 and 4.5% by the end of this year, and then hold at that level and see how the economy and prices react.
I don't see that happening at all. I see us as raising to a level that we believe is restrictive enough to bring inflation down, and then holding it there until we see inflation truly get close to 2% and demonstrate that price stability is restored.
FOMC members Mary Daly and Raphael Bostic there saying that the Fed is unlikely to cut rates next year. That's as traders bet on at least one reduction in 2023. Let's bring in Carsten Bresky, ING's chief economist, who joins us now, and global head of macro. Carsten, great to have you with us. Perhaps our conversations around a pivot from the Fed are a little too binary, and I wonder if you can explain what a meaningful pivot will look like to you, Carsten, because some people seem to be talking about stopping hiking so much, others are talking about stopping hiking, and others are talking about cuts. And depending on what your interpretation of the word pivot is, you can get to a different time horizon. So what are you thinking about?
And I think you can have very long pivots, isn't it? So for us, the pivot really would be stop hiking rates. This is not going to come now, but this should come at the end of the year. I think when you look at what happened this week elsewhere, we had the Reserve Bank of Australia yesterday already signaling a kind of pivot, only hiking by 25 basis points. We had the Polish central bank, which actually stopped hiking interest rates. So if you look very closely around the globe, we already do see that some central banks are at least slowing down the pace of tightening or even stopping it. So for the Fed, it would be, what is the pivot? The pivot means bringing an end to the hiking cycle, and we think that's going to happen already end of this year.
OK, and for them to pivot in any way, Carsten, they might have to see signs of the labour market turning, of inflation data coming down a little. We talked a little on the programme yesterday about whether the Fed was going to be able to weigh down sufficiently on inflation, or whether something else in the economy might break first, as if financial fragility might get in the way of the Fed's tightening plans. Is that something that you're thinking about?
We are definitely watching it. That financial stability is clearly an issue. But I think look at the U.S. economy. Housing plays an enormous, importantly role in the inflation index in the U.S. And with mortgage rates north of 6%, I think it's just a matter of time before we see house prices coming down. And this would then also lead to a very significant drop in headline inflation in the U.S. Think of the strong dollar. Strong dollar should also help bringing down inflation in the U.S. So I think that we will see headline inflation in the U.S. coming down much faster than we will see it coming down in the Eurozone. And this should help the Fed actually then justify this pivot at the end of the year.
OK, that's interesting. We're just showing a chart of inflation, the various measures of it. And, some people are suggesting there are signs that it's peaking. Others saying all these price pressures, they really do persist in the US. Carsten, let me ask you about what you think the impact of oil prices is going to be here, because we've seen action being taken by OPEC+. And yes, that looks as if it lifts oil prices, or it has at least in the run up to that meeting. Others say, no, well, they won't cut really by that much. So it's not going to, it's more of a geopolitical story than it is an economic story. How do you work in what we've heard from OPEC+, what that does to oil prices, and therefore what impact that has on inflation?
Well, it definitely is a geopolitical story, because it also shows that OPEC+ is signing along with Russia in this war in Ukraine. So that is a very important signal that OPEC+ sent to the world. All we have to do, we have to take the announcement there will be cuts for granted. So this means that we're going to see higher oil prices. And you're fully right. This means that in the US, the impact of lower oil prices we just had over the last couple of weeks will be offset, and could mean that at least the energy price component might stay high for a bit longer. But, well, don't forget, I think really the biggest chunk of the inflationary pressure in the US comes from housing. And there we could see a reversal very quickly.
OK, so a reversal on the housing impulse. Carsten, thank you. Stay with us. Carsten Bresky, ING chief economist and global head of macro, staying with us a little bit longer on the programme. We'll get his insights into Europe next. Coming up, the president of the European Commission calls for a price cap on Russian gas as dozens of European leaders, more broad than the EU, gather for a summit in Prague. More on that next. This is Bloomberg.
How much of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
Welcome back to Bloomberg Markets Europe. 40 minutes until the start of cash equities trading. The futures picture actually looks pretty bright. The US futures picture looks bright also, not as bright as the European story. And in fact, the European story has come off earlier highs, but we do see some gains at the start of the European trading day, catching up with the US story of yesterday. Now, the leaders of 44 countries are gathering in Prague for an extraordinary summit in the shadows of the war in Ukraine. For European leaders, the focus is still firmly on energy. This as Russia warns against price caps in a Bloomberg TV interview. For more on this, let's talk to Bloomberg's Maria Tadeo, who's covering the meeting in Prague. And we're saying again, Maria, this is a broader than just EU meeting, isn't it? More than 40 countries, as I was saying there, not just those in the European Union. But the EU Commission leader, Ursula von der Leyen, has been making waves by calling for a price cap on gas. There's division even within the EU on this, though. So is this going to happen?
Well, Anna, she has, and this is a letter that she sent yesterday to the EU 27 governments in which the head of the Commission says the Dutch benchmark, the TTF, no longer reflects the real price of gas. So as the European energy market transitions away from it, she says she's now in favor of a temporary price cap. The problem, Anna, and this is fundamentally the issue, is that there is a number of options in terms of this price cap. What does it look? Well, right now there's at least 5 options on the table. You could argue they're just going to cap potentially Russian gas. Will it be all imported gas into the European Union? Is this about separating the gas that gets used to make electricity? So something similar to what the Spanish already do. And that is the fundamental issue. They all agree prices need to come down ahead of the winter, but the formula, the magic formula for 27 countries, they're still far away from it. And I hear today, Anna, we are not any closer than we were yesterday to a consensus. The idea that by tomorrow they could announce a price cap, I'm being told, is very premature, purely because they have not decided on a formula yet.
And Germany has been opposed to such an idea. Maria, thank you very much. Maria Tadeo joining us there from Prague, where that wider European meeting is set to take place. Carsten Bresky, ING chief economist, still with us. Let's pivot to Germany then, Carsten, and what you're hearing, I suppose, from a German perspective. But thinking across Europe, what are the policy options that you think we're going to see here? Germany's trying to take its own independent action. That's been criticised by some other countries in the European Union. So what happens next from here, do you think?
Well, what happens? I think we will see more national fiscal stimulus measures, and I hope that we'll also get some coordination at the European level. This is how it very often works. So there has to be a common agreement at the European level, like Maria just said, on the price cap. Apparently, it's not going to come this week, but there should be some principles, some common guidelines, so that we cannot have different price cap measures across the country or across the region. When you look at Germany, a lot of discussion has been on this 200 billion euro package. I think also when you look at the details, it is not really 200 billion euro. It is up to 200 billion euro. It is, as very often, a bit of window dressing, using already announced measures, put it in this package. It's also spread over 2 years. But what it means symbolically is, again, that the German government, even though it's a very pro-European government, sends a message to the rest of Europe that it is Germany first and Europe second. And that is not a very good message the government sends.
Right, so that's what's causing waves in Brussels. Carsten, Germany has been then opposed to the idea of a cap on gas prices. Do you understand why? What would be best for the German economy?
Well, for the German economy, we definitely need so many support measures. We need a cap on gas prices, and the government already announced a cap on electricity prices. It also announced, actually, at least the intention to come up with a price cap on gas prices. So I don't know what it is that they're currently still opposing. Problem is that they, even in their own government, even in Germany, they cannot agree on what kind of price cap for gas prices they really want to decide on. So is it going to be based on last year's consumption? Is it going to be capped at a certain amount? Is it going to be capped at a certain price? So the devil is so often in the detail here. I think what is very clear that the German government, the German economy is heading into a very severe winter recession, and we're going to see more fiscal support coming. That's the whole thing.
OK, Carsten, so that's Germany. Let me pivot to Italy with you. We've seen yields going higher on Italian debt products, and there was a warning from Moody's yesterday flagging policy risks attached to the new right-wing coalition. The ECB is also preparing to talk about QT, and that can sometimes be something that spooks the Italian bond market. What are your concerns around Italy?
Well, first of all, we really need to wait until the new government has been set up. So we see that it's going to take a while. And then the biggest concern is that the new government will not be in compliance with previous European agreements, because this would then also stop the ECB from ever triggering TPI for Italy. So the new Italian government needs to stay within compliance with the fiscal rules, with the already existing national reform programs. So if this remains the case, then I think we don't have an issue with Italy. If Italy diverts from this path and, for example, goes the German way, saying, well, all of a sudden we now need big fiscal stimulus, well, then we have an issue.
OK, Carsten, really interesting point to leave the conversation on. Thank you very much. Carsten Bresky, ING's chief economist. Apologies for some issues with the sound there, but I think we got most of what Carsten was trying to communicate. We'll get back to oil and that story shortly. Oil prices extend their rally after OPEC Plus defies Washington, agreeing to its biggest production cut in some 2 years. That's up next. This is Bloomberg.
The 700th anniversary of Dante Alighieri's death has triggered the work of many institutions and offered a very rich schedule of events. Today in Santa Croce, we present one of these projects that suffered a difficult start because COVID-19 has stopped the project that was shared by the Opera di Santi Croce by the Franciscan community from Florence municipality and the Fund for Religious Building of the Internal Minister. Today, Felice Limosani's project is finally enjoyable. In the Pazzi Chapel, the marvelous architecture by Filippo Brunelleschi, the most important images from the Divine Comedy created by the French illustrator Gustave Doré. Through these images we can live the violent emotions of hell, the weight of purgatory and the sublime joy of paradise.
The digital humanities are a cultural occasion to exploit. Summing up, it's about merging humanistic disciplines with new technologies. I find this to be an innovating and modern tool to update culture. Cultural heritage becomes something to hand over to the new generations and not to be put aside, so it's about using technology pixels, and binary code with a human and humanizing content.
Welcome back to Bloomberg Markets Europe. Half an hour to go until the start of cash equities trading for this Thursday morning. Here are your top stories. Biden's rebuke. The White House criticises OPEC Plus for its decision to cut output, calling the move short-sighted. Crude trades flat after 3 days of gains. Energy discord as OPEC Plus unites. EU Chief Ursula von der Leyen tries to rally her bloc behind a limit on gas prices after taking action on oil. European leaders meet in Prague today. Plus, pivot what pivot? Fed officials continue to pour cold water on prospects for a quick policy turn. Mary Daly tells Bloomberg there's a high bar for any change. Welcome back to the programme, everybody. Let's have a quick look at the futures picture then, because we are half an hour away from the start of the European trading session, and the European futures picture looks positive. We've got European futures moving higher this morning, but I should say off earlier highs. So the DAX futures up by 0.8%, CAC futures up by 0.7%. We have been a little higher than that earlier on in the day, and this is all to do with the fact that yesterday the European stocks lost more than 1% on the Stoxx 50. The US managed to close the day pretty strongly. A rally that lasted much of the day, in fact, unwinding the earlier losses. And we need to factor some of that in to the start of our European trading day. So we will do that, no doubt. So the futures picture looks broadly positive. Let's dive into some charts, though, now. And to do that, let's think about the FX markets. We're joined by my colleague, markets editor, Valerie Teitel. Valerie, good to see you this morning. So we've seen world currency reserves shrink by a record $1 trillion. That's the sort of headline story, the calculations that Bloomberg has been doing. Some are saying this is some kind of canary in the coal mine. Why is this grabbing so much attention?
Great. Thank you, Anna. I've got a chart which I think encapsulates why this time it's a little bit different. This is a chart with these white bars of quarterly change in global currency reserves, and this blue line is the Bloomberg Dollar Spot Index. So if we just look at what's happened recently, we've had a huge strengthening in the U.S. dollar and a dwindling of foreign currency reserves. This reflects countries like the Czech Republic, India, intervening in their FX markets to support their currencies. Now, if we take a step back and compare this to last time we had stress like this, in 2008, for example, countries across the globe, or foreign currency reserves across the globe had already been built up. You could almost picture it like their war chests were ready. We had the slowdown that 2008 brought. We had the Fed releasing dollar liquidity into the market via their dollar swap lines, and then after that, we saw the dollar retrace. It's almost like they had enough fodder in their back pocket to weather this crisis. Now, if we take what Mary Daly told us yesterday, that it's a very high bar for the Fed to pivot here, they're not done with their inflation fight. You look at this and you think their war chests are already depleted. The dollar might not be peaking, and this might come back to haunt them because foreign governments and foreign central banks need these currency reserves, because what happens when, for instance, a bank within their economy or a large corporation all of a sudden needs some dollar funding? They turn to the central bank. That's their emergency outlet. The central bank then says, "Sorry, I'm already out." Yeah. This is almost dry fodder for cracks in the financial system to cause instability before inflation has started to reverse in the US.
Okay, and that's into what we were talking about yesterday. It's interesting, we talked a lot about the BOJ and their intervention, but as you pointed out, there are many more central banks that have been doing this. It hasn't just been Japan, or governments rather. We've been hearing dollar funding has been stretched, and you've been talking to us about that for a few days. Perhaps is this a similar situation to early in the pandemic, or is there something that's different this time?
Yes, and to explain this, I've brought up a chart of euro-dollar cross-currency basis, which sounds complicated, but it's really not. It reflects the premium that the premium in which investors and banks are willing to pay to hold dollars instead of any other currency. Now, in 2020, in early 2020, we had the same situation. The line going more negative means investors are more willing to pay a premium to sit on dollars instead of euros, for example, as this chart's showing. But back in 2020, we had completely different dynamics. The Fed was slashing rates. They were amping up their QE program. Again, they released dollar swap lines for other central banks in the world, flooding the world with dollar liquidity. We are far, far, far from seeing that kind of situation where the Fed is going to save us at this point. And already, and in the last few weeks, we've been seeing this dynamic where there's desperation to hold dollars on a balance sheet as year-end approaches.
Okay, and that's what that desperation looks like, that big drop in that blue line there on your chart, Valerie. Thank you very much for that. Valerie Teitel with the latest on a couple of the market dynamics that have caught her eye over the past 24 hours. Let's get a Bloomberg Business Flash. Some of the top corporate stories we're covering this morning. Here's Alice Atkins. Good morning, Alice.
Hi, Anna. Bloomberg has learned that Elon Musk and Twitter have agreed to postpone the billionaire's long-awaited deposition in the company's lawsuit. Musk reversed course earlier this week and said he was committed to going ahead with the $44 billion takeover. The move comes as lawyers try to finalize procedures to dispose of Twitter's lawsuit. The World Trade Organization says global trade will slow next year as major economies face strong headwinds. The WTO forecasts global goods trade will now grow by 1% next year, a big revision on its previous estimate of 3.4%. It blames a cocktail of factors, including rising prices, restricted energy supplies, and growing US-China tensions. And Virgin Atlantic is pulling out of Hong Kong for good. The UK airline is cancelling flights and closing its offices in the Asian financial hub, ending a 30-year history in the city. It says one key factor is closed Russian airspace, which extends flights between Heathrow and Hong Kong by at least an hour. That's your Bloomberg Business Flash. Anna?
Alice, thanks very much. Alice Atkins in London. Now, Russia's Deputy Prime Minister, Alexander Novak, has told us at Bloomberg that the oil price cap imposed by EU sanctions is unacceptable to Moscow. He says it will stop supplying oil to those countries that join the mechanism.
Indeed, there have been two important decisions taken today. One, you have already mentioned, and that is the decision on cutting quotas by all countries present and by all countries in the group. But the second decision, which is just as important as the first one, is actually the extension of the Declaration of Cooperation, because it was scheduled to expire at the end of 22, but now it has been agreed that it will be extended until the end of 2023, which gives the market significantly more certainty and significantly more predictability. And that's why a decision was taken to balance the market out by these cuts, by cuts versus quotas of August. And especially this is very important ahead of the winter season, when we would also see the seasonal decline in demand by 2.5 to 3 million barrels. And this decision, which has been made today, helps the market to balance it out. I think it's a very weighted decision and a timely one.
Let's look towards February 2023. You will have more sanctions, we assume. You will potentially have a price cap. Can you tell me with a surety what your production in February 2023 will be? You say 93% for 2023, but is that the worst case scenario by February with more sanctions and a price cap?
Such actions, as we're seeing, creates, i.e. the price cap, creates a very bad precedent, and will primarily hit the ones who are actually doing it and the ones who are implementing it. We know, and history has a countless number of examples of when market interference, especially with a mechanism of price controls, can only lead to a deficit of a certain good. This mechanism is unacceptable to Russia, and if it is implemented, we are not going to supply countries which join this mechanism.
Alexander Novak there speaking exclusively with Bloomberg in Vienna after OPEC Plus agreed to cut its collective output limit by 2 million barrels a day. Let's get back to our colleague Manus Cranny, who's in Vienna, who you saw there conducting that interview. Manus, it's been a really hectic 24 hours where you are. There's been the cut, there's been the cooperation agreement that he talked about. There's also been EU policy changes, which he was responding to there. What's been your big takeaway from everything that's happened in oil markets over the past 48 hours or so?
If you want to calm a market, you coalesce together and you deliver conflict potentially on the world stage with OPEC Plus against the Americans. Let's deal with Novak first of all. The red headline goes to Novak because basically what he said, you know, you're going to have supply shortages, you're going to have a restriction in supply. That's the risk to Russian supply story going forward on the back of the price caps. We need more detail on the price caps. Then you sit down with His Royal Highness Prince Abdulaziz bin Salman, and again he says, you know, this is going to cause a great deal of uncertainty. We're not sure what's going to happen with these price caps in terms of supply. So I think they've all coalesced around this, but my gosh, Anna, you know, the response from the White House was immediate, and it was during the press conference. I finished with Novak, went back down into the bunker to sit in on the rest of the press conference. So it's pretty stunning. Jake Sullivan's memo says it all, lays it out, doesn't it?
Yeah, so geopolitics to the fore here, how the US responds with the SPR. Well, we already know some of that. I mentioned also that we'd seen the EU approving new sanctions on Russian oil. Today, we're having a European conversation about gas, but back to oil. And there was agreement around a cap on oil. It's a complex mechanism, but that then drew out a sort of veiled threat from Russia, which we just heard there from Alexander Novak. With all of that said, then, what is the outlook for oil?
Look, the outlook for oil, greater minds than I. There are those. I know that's hard to believe, Anna. They're called Goldman Sachs. They say that this is going to get tighter and harder at 110. I don't work at Goldman's, I work at Bloomberg. They reckon $110. So the squeeze is on. And you know what? Ollie and I were just listening back to His Royal Highness. I'm not a masochist. And we went in terms of, you know, I said, are you going to, you know, is the markets ouching like hell enough for you, to quote himself? He says, I'm not a masochist. But he went on to talk about the fragility and the illiquidity in these markets, going back to his August conversation that lit up the debate about the dysfunctionality in these oil markets. He's not setting the stage for a series of jumbo cuts. He was at pains to say that to me. In terms of voluntary cuts, there's no need for those at the moment from Saudi Arabia. I'll leave you with this because I know I got to jog on. He is worried about the strength of the dollar. He is worried about this race by central banks to crush inflation at any cost to growth. Anna.
Manus, thanks very much. Bloomberg's Manus Cranny joining us there from Vienna with the latest on what was an eventful day in Vienna for OPEC. Coming up on the programme, £300 billion, that's been the hit to UK markets since Liz Truss took over. Has the nation become, quote, uninvestable? Are there opportunities? More on the Prime Minister's wild first month next. This is Bloomberg.
Recently, cryptocurrencies have been very popular. And if a client came to you and said, look, I'd like some cryptocurrencies in my portfolio, what would you say?
Oh, we've actually been really deep into crypto, deep into learning about blockchain, and all of the new businesses. You know, I would characterize this as crypto learners. You know, we have made a series of toehold investments on behalf of our clients, both in some of the currency baskets as well as with some venture firms that are investing primarily in the crypto area. I think it has the potential to be completely game-changing, but it is still such the Wild West, and it's so uncertain. But it has the potential to completely upend everything.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The first priority here is organic growth. We clearly indicated also with our capex budget, 12 billion for the next 3 years, that we will keep investing into organic growth. We are very focused on our regular dividend payment. And then, if there is something left, which is fortunately the case at the moment, we will think about inorganic opportunities, and we will also think about other means to allow our shareholders to participate. That is why we are currently running a 2 billion euro share buyback program.
Deutsche Post DHL Group CFO Melanie Kreis there on the latest episode of Bloomberg Chief Future Officer. You can catch that tonight at 6:30 p.m. in London, 7:30 p.m. in Hong Kong. Let's get a Bloomberg First Word News update. Top stories we're covering. Here's Alice.
Hi, Anna. Ursula von der Leyen is proposing that the EU intervenes in the gas market to cap rising costs. The Commission President's plan includes a temporary price limit on the Dutch benchmark gas price, which is used for all gas traded in Europe. Von der Leyen contends the price no longer reflects the bloc's energy reality and the rapidly shrinking share of gas from Russia. The World Trade Organization says global trade will slow next year as major economies face strong headwinds. The WTO forecasts global goods trade will now grow by 1% next year, a big revision on its previous estimate of 3.4%. It blames a cocktail of factors, including rising prices, restricted energy supplies, and growing US-China tensions. King Charles III is expected to be crowned on June the 3rd next year in a ceremony at Westminster Abbey. Bloomberg has learned that British officials are converging on that date, although talks are still ongoing. The coronation, almost 70 years after his mother was crowned, will form the centrepiece of days of celebration to mark the beginning of the monarch's reign. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna?
Alice, thank you very much. Alice Atkins here in London. Now, globally, assets have been hit this year by central bank efforts to tame surging inflation. In the UK recently, things have been especially bad. Confidence has been shaken after a mini-budget, so-called mini-budget, packed with tax cuts, saw the pound hit a record low against the dollar, prompted intervention from the Bank of England in bond markets, and eventually a government U-turn amid questions over credibility. In total, £300 billion has been wiped from the combined value of the nation's stocks and bonds. For analysis, let's bring in our UK stocks reporter, Joe Easton. Joe, very nice to have you with us this morning. So break down for us the hit to markets that we've seen over the last month.
Yes, so as you mentioned, over the entire market, it's been around 300 billion. A lot of that has been in the domestic stock market, so around 80 billion off the domestic market. Obviously, some of the corporate debt as well, the distressed companies, they've seen massive drops in their bonds. And we've seen gilt yields elevated, still up around 4%. They were down at around 3% when Truss took over. They were already on the rise, obviously, given the interest rate environment. But the effect of Truss taking over certainly had a lasting impact. The only thing that's really recovered is the pound, and that's partly because the dollar's sort of come off its highs, and also just a bit of easing of those worries around the UK economy.
Yes, I was going to ask you how much of that initial response then has been sustained, that initial response to the so-called mini-budget. You know, how have UK markets responded, for example, to the government's U-turn? I mean, that did seem designed to limit the political damage, but that was not much of what had created the economic damage.
Yeah, I think the actual fiscal impact is only around £2 billion from that change in tax policy. However, I think what it actually did was it actually showed investors that Kwarteng and Truss can actually probably be reined in a bit, and they can actually probably be convinced by the other MPs on their party to scale back a bit of this. all-out growth policy that they're clearly going for. I think one of the most damaging things at the moment is we haven't had the OBR report on the UK government finances. They can't seem to make up their mind when that's coming out. They seem to think it'll be coming out in the end of November, but that really needs to come out.
Yeah, so a U-turn, which was then sort of U-turned, and our colleague Allegra Stratton calling that a donut. So I don't know what's happening with that one. Let me ask you about where this leaves UK assets then, because I know that in your piece you've got a quote from the Liberum Capital saying that clients are talking about the UK as being uninvestable. But that said, the UK looks very cheap on a lot of measures, and they talk about if profits drop by a quarter, that would leave them, even that would still make them look pretty cheap. So even if profits drop further from here, what are you sort of sensing in that conversation?
Yeah, I mean, I think from my perspective, I think UK stocks look really cheap across a large number of sectors. So if you're looking at home builders, some real estate retailers, and the UK banks specifically. So home builders, they trade on around a 30% discount just to the land that they own. So they own around £30 billion worth of land. The stocks are trading collectively at around 20 billion. It doesn't seem to make sense. UK banks have fallen around 15% since the last budget. So you're talking Lloyds, NatWest, even Barclays, which makes a huge amount of money in the US.
It's the sensitivity to those higher gilt yields, though, and what's happening in mortgage markets.
Exactly. So people are predicting a mortgage crisis. The market's pricing in around a 10% price in drop in UK house prices, which you could argue that seems too bearish. So from my point of view, I do think there's a lot of value in UK stocks.
OK, Joe, thanks very much. Thanks for joining us. Joe Easton from Bloomberg there with the latest on the investability or otherwise of UK assets. Coming up, we'll look at the broader stocks to watch stories today, including Shell, who pointed to a weaker third quarter performance following a record first half. That's up next. This is Bloomberg.
Why does everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrell. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg.
Welcome back to Bloomberg Markets Europe. 7 or so minutes to go until the start of cash equities trading for this Thursday morning, and the futures picture looks a little brighter, factoring in a bit of catch-up with Wall Street of yesterday. We saw a bit of a turnaround. Let's get the individual stocks we're watching, though. Danny Berger joins us with that. And we've heard from Shell this morning.
Right, exactly. Signaling that their third quarter might be a little bit weaker. Of course, this is all coming off the back of some really banner earnings for Shell, so comparables are already really difficult. So they've warned on their chemicals business, margins negative there, looking worse than they had been before. That's just interesting sort of from a macro perspective, since chemicals are used in literally everything. Everything is produced using chemicals, so that's a macro signal to keep track of. Gas business, those margins a little bit weaker as well. But again, and it comes off of just such a strong year for the oil giants. It's not totally surprising to see that come off a little bit.
Okay, and then Imperial Brands, not a business we talk about all that frequently, but some news flow surrounding this company.
Yeah, the cigarette and e-cig maker. So Imperial Brands, a £1 billion buyback. They say that at the moment their debt levels are towards the low end of their targeted range, and that has allowed them the freedom to go into this market, buy about 5.5% of the shares currently outstanding. They're also on target to reach some of their medium-term goals. So overall, a beneficial picture for Imperial, and of course buybacks. Putting that into the market always gives the stock a nice little pop.
Okay, let's keep it sort of UK focused, I suppose. We've got Diageo also out with some news.
Yeah, I also realized not only did I pick all UK companies, but I got all the sin stocks for you. I got oil, I got cigarettes, and now finally alcohol. Diageo saying that they are off to a strong start of the fiscal year of 2023. They're on track to meet their medium-term outlooks. Morgan Stanley writing that this is what they call reassuring, that it's positive for Diageo, that they are on track to hit all these targets. They said it might not change things too much in terms of what their price target is for Diageo, but again, it's that reassurance they've injected into the market.
Okay, well, it is nearly the weekend. Danny with all the sin stocks for you this morning. Nearly, I mean, it's Thursday, nearly enough. Bloomberg's, it's the new Friday. Danny Berger, thank you very much. Let me get back to you from UK stock specifics, perhaps, to some of the oil narrative on a macro level. We've got some interesting calls coming through this morning. Morgan Stanley raising its first quarter 2023 Brent forecast to $100 after that OPEC Plus meeting, saying that oil will find its way to $100 quicker after that OPEC Plus meeting. We saw that big cut to production announced by OPEC, and they're joining other houses in this call because Goldman Sachs has been talking about their fourth quarter target for oil, raised that $10 to $110 a barrel, and UBS talking about Brent advancing above $100 over the coming quarters. Citi, though, also talking about what this does to the oil price, but warning that the move could backfire if it hits economic activity even more, and that does seem to be something that some people are citing when it comes to oil prices. Yes, it can increase inflation, but it can also weigh on demand, of course, as we know. That is it for this hour of programming. Coming up, the European Open is up next. Futures have been pointing broadly higher. US futures also point a little higher this morning. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one, and through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the US shaped the 20th.
Access the financial world on demand.
Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome to the European Market Open, everyone. A minute to go to the start of cash equity trading. I'm Francine Lacqua here in London, and here are your top stories. Not so pumped. The U.S. slams OPEC Plus for its decision to slash crude output, saying the cartel is aligning with Moscow. Rallying cry, Ursula von der Leyen says, calls for EU intervention in gas markets. Regional leaders meet in Prague to seek common ground. Plus, pivot? What pivot? Fed officials pour more cold water on equity bulls. Mary Daly tells Bloomberg an early end to tightening is wishful thinking. So let's take a look at the futures. Despite all of the concern out there in the markets, and we have a pretty scathing review also of what could happen to UK stocks from now on. We have a number of reports actually looking at UK stocks and bonds, and none of them, I have to tell you, are very encouraging or positive. European stock futures gaining some 0.6%, so it does look like we're opening a little bit higher. The bullish sentiment, I guess, weakening the dollar after its biggest jump in a week yesterday, and so that's also potentially giving a bit of a lift. So watch out for currencies, watch out for commodities. I think without a doubt, the biggest story of the day is what's happening with OPEC. Our Manus Krajny on the ground in Vienna with some great exclusive interviews. He was actually the first one to speak to the Russian energy minister. Brent crude, you can see 93.12, so watch out for any kind of impact this has also in terms of spat between Russia and, of course, OPEC and the U.S. The CAC 40 opening up. So we're seeing some of these markets and these equity indices opening. The FTSE pretty much unchanged, but we are seeing gains for the CAC 40 and the IBEX over in Spain. So cross-asset, the one thing we always watch out for, and you know it, you know what it's like, is basically what we're seeing with the U.S. 10-year yield, 3.77. The action, of course, overall in the markets yesterday appeared to rethink on the impact of the decision by OPEC to reduce daily production by 2 million barrels. I'm a little bit surprised at what the markets are doing now, because, of course, the question is, if you reduce by this much, what does OPEC know that economists don't? Now, oil prices trading higher this morning after an action-packed 24 hours. OPEC Plus agreed to cut its output by the most in 2 years, earning a rebuke from the White House. Well, the U.S. National Economic Council Director Brian Deese says President Biden is disappointed by the short-sighted decision.
Well, we were disappointed that OPEC made this decision. As the president mentioned, we think it's unnecessary if you look at the global environment where supply continues to be the predominant challenge. We've been working for some time to take action and encourage action globally to make sure that supply actually matches demand.
And the EU approved new sanctions on Russian oil, drawing a veiled threat from Russia. Now let's head to Vienna, where Bloomberg's Manus Krajny is standing by. Manus, let's start with the rally in prices. I mean, you had some market-moving interviews yesterday. What are traders looking at today?
They're more worried about more cuts to come. It's the 3 C's: caps, cuts, and conflict. I'll come to the conflict in just a moment. To quote one of the great American quotes from the time of war, of the Iraq War, you know, the known unknowns and the unknown unknowns. And of course, we're going into this vortex of the unknown, which are what will the impact of these price caps have on production and prices and volatility. For the Russians, it's going to mean a reduction, a near-term reduction in production. That was the red headline from Novak, the first sit-down with the Deputy Prime Minister, exclusive to Bloomberg. And then the Saudis are worried about the volatility. But let's tune in to Novak and his salutary warning to the West as he arrived in the heart of Europe.
Such actions, as we're seeing, creates, i.e. the price cap, creates a very bad precedent and will primarily hit the ones who are actually doing it and the ones who are implementing it. We know, and history has a countless number of examples of when market interference, especially with the mechanism of price controls, can only lead to a deficit of a certain good. Is that this mechanism is unacceptable to Russia, and if it is implemented, we are not going to supply countries which join this mechanism.
Get ready for volatility. Production drops from Russia. Who's going to fill that gap? The Saudis, His Royal Highness Prince Abdulaziz bin Salman, wouldn't be drawn in terms of his readiness to fill any customer needs that could come from a drop in Russian production. But why cut now? They're painting in this building in the bunker last night, Francine, that you know so well. They painted graphs and imagery, Bloomberg graphs, in terms of the drop in demand, the fragility of demand, the fragility of the situation. But the bottom line is, all that political capital, the fisty bump moment that you saw Biden and Mohammed bin Salman have, that political capital that Biden spent. OPEC is back on the table. That could have the Saudis ouching like hell. And an SPR. You want to cut barrels off the barrel? I'll see you and raise you, because I've got a lot of oil in the bunker in the SPR, and I will release it. Those are the messages coming from the United States of America. Fran, Tom.
Yeah, it does feel like it's just so much more political. There's also a great piece by Javier Blas looking at the, of course, interlinks between some of the decision and what it does also to the coffers in Russia. So Saudi's top oil official saying that U.S.-led plans for a price cap on Russian oil only added to the uncertainty, Manus.
Indeed, and that uncertainty is what's irking everybody. How it's going to play out, where it's going to play out. Let's listen to His Royal Highness Prince Abdulaziz bin Salman.
Lack of details and lack of clarity, and the lack of the fact that we still have 2 months to go for that these two things to be activated. These 2 months would be a period of uncertainty. We don't see what will be the reaction of the market, of the participant.
He again reaffirmed his message that the markets were fragile and illiquid. I pushed him, is this a series of jumbo cuts to come? Are you ready to do that? He pushed back against that. In the macro discussion, and go and listen to the whole interview, because it is worth it. Shameless plug, why not? But it is about the central banks around the world are prepared to chase inflation taming at any cost to growth. But of course, I put it back to him and I said, you know, you're stoking, refueling the inflation fire. The Central Bank of Oil took action yesterday. The question is whether it's a one and done or one of many multiples to come. Tom, Francine.
Manus, thank you so much. I have to say, I'll do a shameless plug for you. It was a fantastic interview. I am unclear what the market is looking at, because either they just think the world economy is going to be much worse than expected, or they're trying to give Russia a helping hand, and that has a whole lot of geopolitical, of course, implications. Manus Cranny, they're on the ground for us with, of course, all of those exclusive interviews, and he'll have plenty more throughout the day. Now let's bring in Bloomberg's Christina Kino and Neil O'Sullivan, Chief Investment Officer of Multi-Asset Strategies for EMEA at Neuberger Berman. So thank you both for joining us. Christina, I'm looking at oil and I'm thinking, like, okay, the oil markets and traders are pretty cool about this. I mean, should we look at it as a geopolitical standoff instead of a imminent recession, red flash warnings?
Well, Francine, it does seem like a geopolitical standoff at the face of it. What I'm particularly worried about is the implications for inflation longer term. I mean, the reason probably that the Americans in particular were very incensed about this, there's of course the political aspect of it, as Manus was alluding to, but then there's also the economic monetary policy aspect of it. This is not going to be a good thing. Higher oil prices heading into the winter time. I mean, the U.S., the Fed officials have been just repeatedly hiking those rates and really trying to get a lid on energy prices specifically, but also inflation more broadly. This is not going to be good news. It's not going to be good news for the midterm election season in November. And so all around, it just spells quite a negative picture for inflation in the U.S., but also globally.
And yet markets are up, which is a conundrum, right? Because it's true, it filters through inflation, it exacerbates the standoff, or they see something ugly happening in oil demand.
And it's probably part of a broader
bigger theme of, you know, deglobalization, where frictions are coming back, allies who used to work together are becoming a little bit more contretemps. I think two things to maybe why the market is a little bit more sanguine about it. It's obviously a 2 million cut, but when you look at the numbers, there were already one under that. So it's probably a net effect of only one by the time you look at it. And secondly, if you go back to earlier on in the year, when you had the situation where the sanctions were coming in, people assumed there was going to be much greater shortage of oil. Unlike gas, which is piped, oil is shipped, and it's made its way through the world into lots of other places. And so the worst effects of that did not happen as expected. So I think markets are still probably watching this to a little extent. However, continuing to have inflation protection in your portfolio is clearly something you need to do.
Yeah, so how do you do that? But Neil, first of all, I also have a morning must read, and today I have to say it was fantastic. It came out late last night by Javier Blas, one of the most brilliant opinion piece writers, especially when it comes to oil. And he says, you know, this is a direct snub to Western governments. So given all the implications, how do you protect your portfolio?
So I think when you look at your portfolio and look at what's going on, there's a lot of things on the commodity side that could happen. The other thing we're not talking about, but the other reason there's been probably a pullback in commodities recently has been in China. Economic activity has been a lot lower than expected. You could look into post the party conference and see a lot of things potentially open up, particularly if something like the zero COVID policies were to be relaxed a little bit, and that could be a real bull case. So having exposure to commodities in your portfolio is clearly something that you should probably have strategically. And also, there's some tactical elements to it as well. Because of those markets at the moment, the roll yield is really, really interesting in commodities. The cost of the spot commodities relative to future commodities, it pays you to effectively take that curve on an ongoing basis. So putting that into a portfolio is a very interesting thing.
Yeah, and then, of course, it goes back to dollar, king dollar. But it took a bit of a breather yesterday.
Absolutely, Francine. It's still kind of very interesting, really, the dynamics of the dollar and everything that's feeding into it this year. I mean, I think there's a little bit of this view that perhaps the peak is behind us, but I'm a little skeptical of that just because of what we keep hearing from the Federal Reserve officials, right? I mean, this week, they've very much pushed back against this idea of a pivot, which buoyed markets initially at the start of this week until we heard from the officials saying, no, hang on, we're going to keep doing this for a little while longer, and that peak rate, we're not even close to it yet. And so, you know, if they're going to be, that's the path of policy moving forward, and they're outdoing everyone else, it's really difficult to see the dollar pulling back on a sustained manner. I think it might be a while before we get to that peak that a lot of people are hoping for.
Yeah, and so we'll talk about, of course, the Fed in just a second. We'll also hear from Mary Daly and Raphael Bostic. What I'm surprised about is that the market wants to believe so bad that they're done with hikes or that they will take care of the economy, that they just keep on trying to price it in. And then you have official after official, you know, that just come on and say, like, guys, we're fighting inflation. We're fighting inflation. This is the one thing, the one job that we want to do right now.
So one of the things that's really interesting, we talk about the Fed, after the GFC, there was a long period where the forward dot, the one way out in the future, stayed at 4% for a really long time, and nobody kind of believed it. Now that dot is sitting at 2.5%, which is, the Fed is telling you, no, we're moving it up here, but the market don't want to go there. So I think there's clearly a desire for people to see peak Fed. Now, what I will say is that when you look at what's going on, I think people have talked about the new normal for a long time. We're probably back to an old normal situation with real rates. The Fed is now data-driven. They used to give you forward guidance. They won't anymore. They have, the market is expecting what it's expecting, but the Fed will react to data.
I mean, I don't want to push back too much because you're absolutely right. But if there's this belief or this longing in the markets, even by just looking at the current data, they have to be aggressive if they're going to go from the inflation number now to 2%. Why is that not being priced in?
Well, I think if you look at the hikes that's in, you have 75 and 50 built in.
Yeah.
They are going to keep an eye on what is happening thereafter. And if you start to get to a recession, if you still start to see things slowing down, my personal view is what they're really focused on is the inflation expectations. That will drive everything. And it's only when they see that that is very, very anchored and they see real evidence of things falling off that they will start to cut. So I would agree with you. We remain in our portfolios positioned that things that will be doing well should financial conditions continue to tighten will be rewarded in portfolios.
Yeah, would you go as far as saying, Christina, just markets are too optimistic? about their own future?
At this point, Francine, yes, I would think so. I mean, again, you're absolutely right. This is kind of the price action that we saw this week is really that kind of hope. I mean, it's almost like it's hopium that the Fed is going to be stopping its policy hiking cycle soon, but we're really just maybe halfway through it at best. And we've seen this before, right? I mean, over the summer, the narrative was peak inflation, which was very quickly shattered when we saw successive CPI prints that really exceeded expectations. I think we're in danger of kind of falling into that same trap again this week, especially ahead of those non-farm payroll numbers tomorrow. I think if that affirms the Fed narrative that they're going to keep moving forward, then markets have to recalibrate their expectations.
All right, thank you both. We have plenty more, of course, on the Fed. Bloomberg's Christina Kino, and staying with us, Niall O'Sullivan, Chief Investment Officer of Multi-Asset Strategies for EMEA at Neuberger Berman. Coming up, more Fed speakers pour cold water on hopes of an early dovish pivot, so we continue that markets conversation next. This is Bloomberg.
How much of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
I'm Kaylee Lines.
And I'm Damian Sassower. Join us each week on our brand new show, The Lineup. If you're betting on the Mets, it's a pretty good return.
We'll cover the latest trends in sports betting, the hottest matchups, shifting spreads, and the data you can't find anywhere else. It is crazy how much the money line has changed from the preseason to now.
Plus, expert insights from special guests.
The Eagles got a gem on their hands. I hate to say it because they're in the NFC East with the Giants.
Odds are it'll be your favorite way to stay in the game.
Catch The Lineup Fridays and Saturdays only on Bloomberg.
I don't see that happening at all. I see us as raising to a level that we believe is restrictive enough to bring inflation down, and then holding it there until we see inflation truly get close to 2% and demonstrate that price stability is restored.
I'd like to reach a point where policy is moderately restrictive, somewhere between 4 and 4.5% by the end of this year, and then hold at that level and see how the economy and prices react.
Well, those are some FOMC members, Mary Daly, Raphael Bostic, echoing that the Fed is unlikely to cut rates next year. We're back at Talking Markets with Niall O'Sullivan, Chief Investment Officer of Multi-Asset Strategies for EMEA at Neuberger Berman. Now, I think I'm pronouncing it right. Do I get full marks for that? This was like my only stress today, apart from looking at treasuries and trying not to get the market expectations wrong on that. What needs to be repriced, like now, not tomorrow? Is it treasury or equities?
I think, as I said earlier, I think the Fed is becoming increasingly data-driven, so it's very hard to look out forward. They're giving you a very clear steer, and they want the market reined in. I think the Fed would like to tighten financial conditions generally. The Fed rate is only a very small part of that. When you look at the financial conditions, equity markets and the 10-year rate are equally as important. There is no doubt that the Fed is not in favour of financial market conditions loosening and is doing its best to reassess that from Jackson Hole all the way through to now. And I think when you look at that, you certainly would be concerned that the equity markets, particularly in the US, have probably retrenched a long way. Yeah. And so therefore, the fear would be that this will be another of the bear market rallies that we've seen along the run.
I know in your conviction call, so you have, for example, short duration opportunities in credit and high yield. Is that G7 countries?
I think, well, in particular, what you're looking for is one of the big themes we're going for is favour the fittest. Right. So this is going to be a tougher market. So in particular, in that context, just return for equities for a second, I would be very much focusing on low volatility, higher quality, stuff that is already marked down. On the fixed income side, I think in particular, when you look at some pockets in the US and elsewhere, you have over the next number of years, a recession should it come, not likely to be very, very aggressive. But pricing built into credit spreads would be much more in line with a very much steeper recession. So particularly on a 2-year, 3-year view in investment-grade credit and high yield, you could see that those assets will be money good in the end. It could be a bumpy ride from here to there, though.
Okay, what's a bumpy ride? Like actual pain both ways?
I think you will see falls in value along the way, because if there becomes growth fears, then every high yield asset will reprice. But I think they will ultimately end up money good over that period because of the protection that has been. There will, of course, be defaults, but the spread will be greater than the defaults will realise, we believe.
When you look at the government chaos here in the UK with the U-turns and the pretty chaotic Conservative Party conference, is the UK investable?
I think the UK faces some real problems, particularly when you are reliant on the kindness of strangers, when you're running a budget deficit, a twin deficit. So you need to have the confidence that is there. I think what you've seen over the last few days and weeks with effectively the OBR coming back on the picture, though nobody's 100% sure when, with the movement and tax cut, is evidence that they're trying to be a little bit more market aware and market savvy. But I think you also have some key dates coming up over the next while when the Bank of England removes its support and the LDI market needs to go back in and function. The one thing I will say there, though, not since Mario Draghi has a central banker achieved so much with so little being spent. To date, the Bank of England has only spent about 3 billion of the promised 65, and it has managed to stabilise and normalise those markets.
Yeah, but in 10 days, effectively, there's no, last buyer or buyer of last resort.
There's no stated last buyer of resort, but the market has learned a lesson. And I think, generally speaking, one of the other lessons I think that is out there is the central bank put that has been there for a while is probably still there should there be financial stability threats like we saw in the UK or indeed elsewhere. Not necessarily much used for equity markets, but very useful for credit markets.
Now, thank you so much, Niall O'Sullivan, their Chief Investment Officer of Multi-Asset Strategies for EMEA at Neuberger Berman. Now, coming up, £300 billion, that's been the hit to UK markets, both, I think, bonds and markets and equities since Liz Truss took over. Has the nation become uninvestable? More on the PM's wild first month. That's coming up next, and this is Bloomberg.
Cryptocurrencies have been very popular. And if a client came to you and said, look, I'd like some cryptocurrencies in my portfolio, what would you say?
Oh, we've actually been really deep into crypto, deep into learning about blockchain, and all of the new businesses. I would characterize this as crypto learners. We have made a series of toehold investments on behalf of our clients, both in some of the currency baskets as well as with some venture firms that are investing primarily in the crypto area. I think it has the potential to be completely game-changing, but it is still such the Wild West, and it's so uncertain. But it has the potential to completely upend everything.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
The markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Welcome back to the Open, everyone. 23 minutes into the European trading day. Big news, of course, on OPEC and energy, but you can see stocks for the moment gaining some 0.7%. Now, globally, assets have been hit this year by central bank efforts to tame surging inflation in the UK recently. Things are especially bad. Confidence has been shaken after a mini budget packed with tax cuts saw the pound hit a record low against the dollar, prompted intervention from the BOE and eventually a government U-turn amid questions over credibility. Now, in total, 300 billion pounds have been wiped from the combined value of the nation's stock and bond markets. Now, for analysis, let's bring in our UK stocks reporter, Joe Easton. Joe, great to have you on the program. I mean, this was pretty brutal, right? 300 billion pounds wiped off. And this goes, I guess, to the credibility of the markets. Why have the markets freaked out so much?
Well, I think that the big issue here is this all-out push for growth is obviously going to mean higher interest rates across the board from the Bank of England, also the mortgage market. Probably going to see potentially a crash in the mortgage sector. And the big issue now looking forward is we really need to see this report from the Office of Budget Responsibility that's going to sum up the state of the UK government finances, because that's the only thing that investors can really go on and really judge how sustainable this fiscal expansion is. So the government can't seem to make up their mind on when that'll come out. Yeah. It looks like it'll come out in the end of November now. And that was actually the big thing that we saw from Fitch last night with their warning on the UK credit outlook. They need to see that report.
Joe, I have to say, I looked at the latest mortgage news. I had to sit down with a drink of my choice to absorb the news. So the key UK mortgage rate climbing above 6% for the first time since 2008. Are you hearing possible defaults or things like that?
Yeah, 6% is the key level that's like red flag for the banking industry. Once it goes above 6%, then it brings into question the health of the debt that these banks own. And that's why we've seen a big sell-off in UK banks. Even since the budget, I think Lloyds, NatWest, companies like that, they're still down around 10% because they're worried that these mortgages will actually go bad at the lower end of their mortgage books. There could actually be big defaults and big provisions booked at the next earnings season. I
mean, this is a huge news. We really are spending a lot of time, and thank you to your team to really keep on top of this. So UK markets, how have they responded to the U-turns by the government? And, you know, yesterday was that Liz Truss speech.
Yeah, so I think the U-turn, it was kind of a strange one, because what it did really was it showed us that the government can actually be reined in a bit. So Kwarteng and Truss can actually be kind of tamed by the MPs on their party that don't want to lose their jobs at the next election. And they're saying, look, you can't just do these tax cuts that won't play well with the electorate. So that was actually a relief for the market. Fiscally, it's only worth around £2 billion in terms of the bill for the budget. But politically, it showed investors that actually this policy of all-out going for growth might not last. We might see the cost of government debt come back down, and that would reduce the interest rate crisis.
Joe, thank you so much. Joe Easton there with the very latest. Interesting to see the markets, of course, keeping the government in line and then their own MPs. Coming up, the president of the EU Commission calls for a price cap on Russian gas. We'll have a full roundup of all energy news. This is Bloomberg. I'm going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city, it's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It's the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrell. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg.
This is Bloomberg Daybreak Middle East.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. Welcome to Bloomberg, the lineup. Welcome back to the Open, everyone. 30 minutes into the European trading day. Here are your top stories. Not so pumped. The U.S. slams OPEC Plus for its decision to slash crude output, saying the cartel is aligning with Moscow. Rallying cry, Ursula von der Leyen calls for EU intervention in gas markets. Regional leaders meet in Prague to seek common ground. Plus, pivot? What pivot? Fed officials pour more cold water on equity bulls. Mary Daly tells Bloomberg an early end to tightening is wishful thinking. So this is a picture overall for equities. European stocks actually advancing, supported as investors weigh the impact of rising oil prices on risk assets. Also, watch out for dollar for the moment. We're seeing a lift on the upside. The FTSE, of course, questions as we have about 3 reports, and all of them, I have to say, are not painting a very nice picture for the UK, gaining some 0.2%, whereas you can see the DAX gaining 1%. Now, this is a sector breakdown, and of course, energy is the one we need to watch for. But for example, the Treasury 10-year yield, and I'm looking here at the Bloomberg terminal, you can do that with Bloomberg anywhere, edging higher, the dollar weakening after its biggest jump in a week on Wednesday, the pound erasing gains. And so some of these sector moves are also based on currencies. We have retail, travel, and real estate on the upside, gaining between 1.2 and 1.9%. We just have a bit of pressure on energy, down 0.8%. So the leaders of 44 countries are descending on Prague for an extraordinary summit being held in the shadows of Russia's war in Ukraine. Now, for European leaders, the focus is still firmly on energy. This comes as Moscow warns against a price cap in a Bloomberg TV exclusive. For more on all of this, let's bring in Maria Tadeu, who's on the ground covering the meeting in Prague. So, Maria, the head of the Commission, Ursula von der Leyen, calling for a gas price cap. Will it actually happen?
Well, Francine, she has, and this is a letter, is 3 pages that she sent out yesterday to the heads of the EU 27 governments, in which she argues when you look at the Dutch benchmark, the TTF, it no longer reflects the true cost of gas, and therefore the European Union has to transition away from it. Now, the issue is you have now 17 countries in the EU that say they are in favor of this price cap. The Commission is responding to that, but the problem is they don't have the formula. And Francine, when we talk about a price cap, there's at least 5 different options on the table. What I hear is that there is no consensus in terms of the formulation, in terms of the structure, and this is what this meeting will be about, to try to figure out a consensus area in which the 27 can live with. Remember also, by the way, that Germany has said up until now they do not favor a cap because of the repercussions it could have on supply.
Yeah, so that's the energy challenge. How much of this is politics? You have 44 heads of state, including Liz Truss.
and she is finally taking part in this European political community. Now, this is a trial run for a concept that in many ways was brought forward by the French President Emmanuel Macron. The idea is that this is a space where EU countries and non-EU countries, but that clearly have the same common interests, can gather together and have a debate. Remember, Francine, a few weeks ago, Liz Truss was asked, is Emmanuel Macron a friend or a foe of the UK? And she could not really put out an answer. She said the jury's out on this question. Perhaps today they can clarify things between the two. And then the other issue that will feature too is this common response to the war in Ukraine. This overshadows everything, as it often is the case in any political meeting that is happening these days in Europe. It's a common response, how to respond to the Russian aggression.
Maria, thank you so much. Maria Tadeo there on the ground for us in Prague. Now, joining us to talk about the economy is Jari Sten, Chief European Economist at Goldman Sachs. Jari, thank you for being here and actually in person in the studio. When you look at some of the challenges out there, I think there's nothing good coming out of this OPEC decision, because they either see a much slower turn for the economy, or it just exacerbates this division. What's the impact for Europe?
Yeah, so we do think the decision to cut supply is going to push oil prices higher from here. We just raised our forecast to 110 later in the year as a combination of tight supply, but then also strong demand as we substitute away from gas into oil. Now, of course, the effect of higher energy prices means, on the one hand, slower growth, but it also means more persistently high inflation. And I think the latter is probably key at the moment, because central banks are still struggling with high inflation rates.
But you're not reading this as a kind of like collapse in demand from China or a complete recession worldwide that OPEC is anticipating?
I think it's more that you've seen a significant slowdown in growth around the world. It's been pretty broad-based. So oil prices, as part of that, have been falling. And so these supply cuts, I think, are designed to put a floor under that and are probably going to work to push up oil prices somewhat in coming months.
How problematic is it that these central banks are basically hiking into a recession, into the winter where we also need to heat ourselves?
Yeah, I mean, it's a classic supply shock where you have, on the one hand, higher inflation, on the other hand, lower growth, and we think recession across Europe. So it's a difficult trade-off for central banks. But at the same time, I think they've been very clear that the focus is on inflation. So particularly the ECB has a single mandate, price stability. That's where the focus is. And that's why we think, for now, these pretty large rate hikes will continue, and we don't see a central bank pivot around the corner.
But so the UK also in the mix, which has complications of their own. First of all, where do you see the UK headed? And because of the fiscal spending that we weren't sure how they were funding it, is it a warning shot to other European countries?
Yeah, I think first of all, the key issue in the UK is, of course, that it has both the tight labor market that the US has and also the big energy shock that the euro area has. And so that's really, I think, the context in which we have to see this fiscal expansion, which, of course, is helping to cushion the depth of the recession, we think, but is adding to the medium-term inflation pressures. And so we do think, bottom line here, is that the Bank of England needs to step up the pace of tightening, and we do think they will step up to 100 basis point hike in November to try to rein in these increased medium-term inflation pressures.
What about QT? Is this a mistake?
Well, it has been delayed, and of course the focus has really been on financial stability, on gilt market functioning. I think that has been quite successful, and we do think that they're going to be more cautious with QE, with the asset sales, when they start in coming months.
Just so that we fully understand, because we also had this pretty incredible, mortgage rates hitting 6% the first time since 2008. If there were to be a sharp downturn in the UK, maybe more than you're expecting, where would you see it first? In the housing market or elsewhere?
Yeah, I mean, generally it's about the consumer, the cost of living crisis, high energy prices. So we really think that it's going to be consumption that will drive the economy into recession, and in fact we think we are already in recession. Of course, the fiscal expansion is going to cushion some of that, so we think it's going to be a relatively moderate recession in the base case, but I certainly think that the housing market could be one source of a bigger hit to growth in coming months. And so, for example, with current mortgage rates, the interest payments that households have to do on mortgages could go back up to where we were in 2007, which of course would imply a further drag on household spending.
Talk to me a little bit about what you're seeing in the U.S. So you have, the Fed not wanting to pivot, and actually you see officials being, quite aggressive. What does that mean for the rest of the world? Because if dollar continues going higher from here, it's problematic for everyone else.
Yeah, so I think in the US we've seen some progress towards the labor market rebalancing that's needed. So at the end of the day, you have too many jobs relative to the supply. They need to rebalance that. So for example, earlier this week, the JOLTS numbers, the job openings that came down, I think were quite helpful. At the same time, you still have strong wage growth, strong underlying inflation pressures. And so we think it's too early for the Fed to stop hiking. We think they will do a 75 basis point hike in November and some more to get to 4.75%. Now, that does imply, we think, continued upward pressure on the dollar. And so we do think that the European currencies will weaken somewhat more against the dollar. Yeah. And of course, that does raise the pressure on both the Bank of England and the ECB. And so we do think that another 75 basis point hike is very likely for the ECB in October. I think what they do in December depends on how the inflation numbers will evolve, but our base case is that they will hike all the way to 2.75. And of course, the weak euro, the pressure from higher rates in the US is part of that story.
Should they just go 1 percentage point at the next one?
I think 75 basis points is a pretty rapid clip. I think it's likely they do another 1, if not 2 of those, and then I think it's likely they slow down.
All right, Jari, thank you so much. As always, Jari Stender, Chief European Economist at Goldman Sachs, joining us in the studio today. Now, oil prices extending their rally after OPEC Plus defies Washington, agreeing to its biggest production cut in 2 years. We'll have a full roundup of that story next, and this is Bloomberg.
No one covers the world like Bloomberg.
The pressure cooker just got far too hot in Birmingham for the government to handle.
You foresee 2/3 of the crypto hedge funds will disappear. Are we close?
The European Union will support and defend Ukraine's territorial integrity.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Why does everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
back to the Open, everyone. 43 minutes into the European trading day. We're still holding on to gains, but actually we're seeing a bit of a reversal for the FTSE. That was earlier gaining some 0.2%. The biggest story in town is, of course, energy. The impact of that on energy will be translated, of course, through inflation. Traders weighing this oil curve, but Treasury 10-year yields in the U.S. also edging higher. The dollar actually weakening after its biggest jump in a week yesterday. Now, OPEC Plus agreed to cut its output by the most in 2 years, and the EU approved new sanctions on Russian oil, drawing a veiled threat from Moscow. Now, speaking exclusively to Bloomberg in Vienna, Russia's Deputy Prime Minister Alexander Novak says the EU's price cap may backfire.
Indeed, there have been two important decisions taken today. One, you have already mentioned, and that is the decision on cutting quotas by all countries present and by all countries in the group. But the second decision, which is just as important as the first one, is actually the extension of the Declaration of Cooperation, because it was scheduled to expire at the end of 22, but now it has been agreed that it will be extended until the end of 2023, which gives the market significantly more certainty and significantly more predictability. And that's why a decision was taken to balance the market out by these cuts, by cuts versus quotas of August. And especially this is very important ahead of the winter season, when we would also see the seasonal decline in demand by 2.5 to 3 million barrels. And this decision, which has been made today, helps the market to balance it out. I think it's a very weighted decision and a timely one.
Let's look towards February 2023. You will have more sanctions, we assume. You will potentially have a price cap. Can you tell me with a surety what your production in February 2023 will be? You say 92-93% for 2023, but is that the worst case scenario by February with more sanctions and a price cap?
Such actions, as we're seeing, creates, i.e. the price cap, creates a very bad precedent, and will primarily hit the ones who are actually doing it and the ones who are implementing it. We know, and history has a countless number of examples of when market interference, especially with the mechanism of price controls, can only lead to a deficit of a certain good. This mechanism is unacceptable to Russia, and if it is implemented, we are not going to supply countries which join this mechanism.
Well, that was Russia's Deputy Prime Minister Alexander Novak for an exclusive conversation with our Manus Krani. Meanwhile, Saudi Energy Minister Prince Abdulaziz bin Salman says the U.S.-led plans for a price cap on Russian exports only adds to market uncertainty.
We wanted to give the market a clear direction, a clear input. That's why we extended the agreement to end of 23, but we still have the same tools in our kit. Guidance to the market is crucial, because without guidance, people would not invest, would not feel safe that they could invest. However, we still have the tools in our kit. We still, we reduced the amount of meeting, we reduced the amount of overall expectations of doing something, but we still maintain the same flexibility. We still have every 2 months we will have a GMMC. That GMMC is warranted the authority to have more than a meeting in every 2 months. It also was given the authority to call for a conference meeting if necessity dictates that.
Part of the toolkit, and the Kingdom has often done this, which is led from the front and gone with voluntary cuts or adds to do the right thing to right the market. Mm-hmm. Did you consider a voluntary additional cut for Saudi?
Well, at this time now, there is no requirement for it. I think amongst us, we sort out a good deal. Mm-hmm. It certainly, we had to be very practical, given the situation prevailing in some countries that are not able to produce their allocated voluntary volumes. And because of that, we elected to go for a bigger number, but in the final analysis, it will be a smaller number, but certainly a significant number. And therefore, we feel it is sufficient for now.
Well, that was the Saudi Energy Minister, Prince Abdulaziz bin Salman. We'll have plenty more from those two great interviews from our Manus Cranny later on the programme. Now let's get straight to the Bloomberg First Word News. Here's Alice Atkins. Hi, Alice.
Hi, Francine. Germany factory orders dropped in August, hinting at a lack of momentum as Europe's biggest economy stands on the brink of a recession. Demand fell 2.4% from the previous month, though data for July was revised upwards to show a gain. This came after the late reporting of some large aerospace orders. The World Trade Organization says global trade will slow next year as major economies face strong headwinds. The WTO forecasts global goods trade will now grow by 1% next year, a big revision on its previous estimate of 3.4%. It blames a cocktail of factors, including rising prices, restricted energy supplies, and growing US-China tensions. North Korea has fired 2 suspected short-range ballistic missiles towards waters where a US aircraft carrier had been deployed, making it a total of 10 launches in less than 2 weeks. That's one of its biggest test barrages under leader Kim Jong-un. The firings came shortly after Pyongyang condemned the Biden administration for escalating tensions. And King Charles III is expected to be crowned on June the 3rd next year in a ceremony at Westminster Abbey. Bloomberg has learned that British officials are converging on that date, although talks are still ongoing. The coronation, almost 70 years after his mother was crowned, will form the centrepiece of days of celebration to mark the beginning of the monarch's reign. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Alice, thanks so much. Alice Atkins in London. Coming up, we'll have more market reaction to OPEC's biggest production cut in 2 years. This is Bloomberg.
At the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
August jobs were right on target.
Pretty much in line with what Wall Street expected. A Goldilocks jobs report.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Does this imply that central banks will blink?
They want to see a little bit more slack in this labor market.
I don't think the Fed wants to see unhappy people.
There is a lot of monetary contraction and austerity coming down the pipe.
The September Jobs Report, Friday on Bloomberg Television and Radio.
Welcome back to the Open, everyone. So we're 53 minutes into European trading day. We're still seeing gains across the board, but actually not as much as previously. So there's a bit of a pause. Certainly there is in U.S. futures. Look, European stocks modestly higher, but again, it's not the kind of 1% gain that we saw 30 minutes ago. Investors now debating whether higher oil prices would further weaken growth, potentially maybe slowing central banks' rate hike cycles. Now, let's also take a look at how the markets are moving in the first hour of equity trade. Joining us now is Jan Patrick Barnett. JP, the problem actually is that there's a million ways of looking at this OPEC decision. You either think they're seeing something that we don't, or you say, look, this will, of course, fuel inflation, and what do central banks do?
Well, yeah. So it's at this point, I would say it's for the market, for the stock market especially. It's not super bad news, but it's also not great in the sum of all things. So I was talking to a couple of people this morning, and they all said, like, look, this is probably going to keep inflation higher for longer, and that's not something that we want to see at this point. But on the other hand, as long as oil remains below the $100 mark, at least in the long run, then probably people can live with that in some way or form.
So traders, it seems, not taking the hawkish signals from the Fed as gospel. What can you tell us?
Well, I mean, we talked about this yesterday and saying like that people are looking for that Fed pivot point in earnest to drive the market higher. So we didn't get that from the first speeches we saw, but we also did not get a more dovish tone. So that's good news there. I think like a more hawkish tone. So that's good news there. But the thing is, like, markets still believe that if the economy is cooling and we are moving into a recession territory next year, that the central bank could probably cut rates, and that's still the playbook that they are positioning for. Nevertheless, what the central bank is saying at this very moment.
JP, any chance of this equity rally being sustained?
Again, we are in a market that is driven by a lot of short-term technical factors. Positioning has been playing a big role these days, where we have seen like super bearish positioning in option markets and in trend following people. So this has driven the rally so far. And what we would need to see now is like more the fundamental guys, the long-term investors, becoming a little bit more bullish. That's not the case so far. On the other hand, I find it very interesting that everybody is suspecting this rally will not be sustained. That usually, if everybody is on the same side, means the opposite happens. So it's going to be interesting to see if this was a contrarian call to say this rally will not be sustained.
Definitely interesting. Thank you so much, JP Barnett, there with the very latest on some of these stock moves. Now, that's it for the European Market Open. Surveillance Early Edition is up next. Once again, U.S. futures actually stalling. If you look at the oil price action, it's stoking the inflation debate. Now, the decision by OPEC Plus to reduce output really drew a warning from the White House about the negative effects on the global economy. And then we have a breakdown. It's different if you're at Goldman Sachs or if you're at Aberdeen, what you're expecting the target for Brent to be. I think Goldman Sachs, in the fourth quarter, that price target for Brent is at $110 a barrel. We'll have plenty more, of course, on the market action. We'll look at geopolitics as well. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one, and through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the US shaped the 20th.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg. I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Not so pumped, the U.S. slams OPEC Plus for its decision to slash crude output, saying the cartel is aligning with Moscow. Rallying cry, Ursula von der Leyen calls for EU intervention in gas markets. Regional leaders meet in Prague to seek common ground. Plus, pivot? What pivot? Fed officials pour more cold water on equity bulls. Mary Daly tells Bloomberg an early end to tightening is wishful thinking. So, first thing is first, let's check in on the markets. We've been bouncing up and down a little bit. I mean, not down, but certainly we opened about 1% higher, and you can see now European stocks gaining some 0.4%. This is all about perception. Do you think that if OPEC cuts a lot and inflation goes up, does it make the central banks more aggressive in hikes? Or on the contrary, do you think that it really hurts, tipping the world into a recession? And so are they a little bit more accommodative? If you're on a trading floor right now, this is the thinking that you need to decide on, and that will change your view on some of these equities. S&P futures, you can see now largely unchanged, but on the lower side, a lot of focus because we have 3 surveys here in the UK on whether the UK is still investable. For the moment, that stock price of FTSE 100 is actually unchanged. We also worry about mortgages, now at a 6% high. Let's remember this is the highest since 2007. The DAX gaining 0.6%, similar to the CAC 40, 0.3% higher. Now, Saudi Arabia's energy minister, Prince Abdulaziz bin Salman, says U.S.-led plans for a price cap on Russian exports are fanning the uncertainty that drove OPEC Plus to its biggest production cut in 2 years. Now, the minister refuted claims that Riyadh is siding with Moscow over the West.
I would say an insulting view to assume that OPEC Plus is nothing but Saudi Arabia and Russia degrading, and too unfair, because from day one, as I took office, I was saying, as a chair of OPEC Plus, I will treat every member of OPEC Plus as equal as any of us, simply because we need the consensus.
Let's head to Vienna, where Bloomberg's Manus Krein is standing by, our news-breaking machine. So, Manus, what's the latest? You had 2 very important interviews, Saudi Arabia and Russia. What did you learn?
There's going to be a vast amount of uncertainty on the implications on the price caps from the Russian side and from the Saudi side. This is what they are perhaps most fundamentally worried about or concerned about. I would just emphasize that I did try to press His Royal Highness Prince Abdulaziz bin Salman on the response in the bunker last night from Jake Sullivan in terms of an SPR release, in terms of potentially NOPEC coming to life again. He would not be drawn on those issues, Francine. We're not here to deliberately jack up prices. We're not going for a jumbo set of cuts. And indeed, he did warn. Yes, you could say they are seeing a 10% rally in prices. That's going to fuel inflation. But as he said back to me on the inflation side, he said central banks, this vehement commitment by central banks to tame inflation regardless of the impact on growth. Those are the jumbo issues, as it were, that we talked about. But when it comes to price cap, the critical red headline went to Novak. He stole the show in the prints on the headlines. It was about price caps and the impact on production in the near term for Russia. Let's listen in.
Indeed, there have been two important decisions taken today. One, you have already mentioned, and that is the decision on cutting quotas by all countries present and by all countries in the group. But the second decision, which is just as important as the first one, is actually the extension of the Declaration of Cooperation, because it was scheduled to expire at the end of 22, but now it has been agreed that it will be extended until the end of 2023, which gives the market significantly more certainty and significantly more predictability. And that's why a decision was taken to balance the market out by these cuts, by cuts versus quotas of August. And especially this is very important ahead of the winter season, when we would also see the seasonal decline in demand by 2.5 to 3 million barrels. And this decision, which has been made today, helps the market to balance it out. I think it's a very weighted decision and a timely one.
Let's look towards February 2023. You will have more sanctions, we assume. You will potentially have a price cap. Can you tell me with a surety what your production in February 2023 will be? You say 93% for 2023, but is that the worst case scenario by February with more sanctions and a price cap?
Such actions, as we're seeing, creates, i.e. the price cap, creates a very bad precedent, and will primarily hit the ones who are actually doing it and the ones who are implementing it. We know, and history has a countless number of examples of when market interference, especially with the mechanism of price controls, can only lead to a deficit of a certain good. This mechanism is unacceptable to Russia, and if it is implemented, we are not going to supply countries which join this mechanism.
Deputy Prime Minister of Russia on his first trip to the heart of Europe, sanctioned by America, access by Europe to talk oil and endure the relationship with OPEC and OPEC+. Price caps are supposed to keep the oil flowing. It's going to reduce Russian production, and it's going to introduce volatility, according to the Saudis, Francine. So those are the messages coming through from both sides here.
Yeah, great interviews. Manus Krani on the ground for us there in Vienna. Thank you so much. Now, we're also joined by Karen Carniol-Tombor, Co-Chief Investment Officer for Sustainability at Bridgewater Associates. Karen, thank you for joining us. I mean, there's a different number of plays outside from sustainability, but of course 100% linked to this. What do you see as the main market schisms that could get us away from more money being poured into sustainable investments?
I think that this environment has helped investors reflect on what their values are and what they're trying to do in choosing to move towards sustainability as a goal. You've had a 9-month environment where cash has been king. The tightening, the fact that real yields have been rising and central banks have needed to catch up was the single most important force in markets. So all assets did poorly. And within that environment, the one best performing asset was any kind of energy that got very squeezed. And looking ahead, you're likely to have a very tough environment for investors continuing as policymakers battle between not being able to get what they want on inflation or on growth. And I think that that's left investors in a tough spot, whether or not they prioritize sustainability goals. And those who prioritize sustainability goals, in some sense, more committed given how much the world has changed.
Karen, how has the world changed in terms of perception, but also inflation because of that massive OPEC cut?
I think that the OPEC cut is the news of the day and likely to sort of put a supply bottom, if you will, underneath what could be a lot of downward pressure on all commodity prices from the fact that now you have all these interest rate hikes in the system. And so what's happening is, you had this huge inflationary force coming into this year that was going to show itself both in nominal demand and in inflation. And that's what we got, some of the highest nominal growth we've seen. Now that there's been as many interest rate hikes as we've seen, there is a lot in the system to slow the economy, and that's going to take some time, but it's going to slow the economy. It's going to slow demand. And from the perspective of any price, certainly oil, you have to get some decline demand showing up in lower prices unless supply gets cut. I still think that the decline in the economy that's coming is more severe than expected, and that the supply decline helps put some bottom against that.
But Karen, why do you think markets are still, pricing in this Goldilocks scenario, or are they too optimistic about their own future?
Absolutely. I think markets are pricing in this Goldilocks where somehow magically both we don't have a very severe recession and earnings don't get hurt very much, and inflation sort of magically comes down to where central banks want it to be. I think the reasons markets are doing that is because it's what we've gotten used to. We've had many decades where central banks were able to get what they want. They weren't very constrained. There were so many secular deflationary forces that pretty much every time the economy slowed a little, central bankers could ease massively into that situation, not risk inflation, and inflation would never get out of their control. But the secular environment has changed very significantly. There are big secular inflationary pressures coming into the environment. And I think it's going to take some number of years for markets to adjust to that and realize just how constrained policymakers are and how they're not going to be able to get both the economy and unemployment outcome they want and inflation outcome they want at the same time, which basically necessitates lower equity prices.
But so, Karen, if you look at all of these challenges, because of the proximity to Russia, and I guess, the buffer that Europe doesn't have, is it going to be the region that will really underperform the rest of the world?
Yes, I think Europe and the UK have already borne the brunt of this environment because they're the regions that are also having a more secular competitiveness shock. That's a much deeper shock than it's kind of the one-off of COVID, if you will. These are economies that are reliant on having access to at least competitive energy prices relative to the rest of the world to have a manufacturing sector. And that shock, the inability to get energy at the same prices the rest of the world is going to be, and the need to actually ration them, actually experiencing stagflation. It isn't just rising inflation and rising demand, but you actually have to ration energy away from households, away from businesses. That's going to be a very long, much deeper, more challenging shock than to the rest of the world, because beyond getting the immediate, acute phase right now of getting through the winter, there's this long-term competitiveness issue that's going to come. And you see it already with the central banks dealing with much tougher circumstances, wanting to protect households, but already running into what feels like a balance of payments crisis. And those conditions where they realize that, they're going to get currency weakness and balance of payments pressures if they try to print money into rising inflation, and yet they also want to protect their economies.
Yeah, and we have a great chart, Karen. We'll get back to that our Valerie Teitel put together looking at break-evens versus WTI. Karen Carniel-Tombor from Bridgewater Associates stays with us. Coming up, more Fed speakers pour cold water on hopes of an early dovish pivot. We continue the markets conversation next. This is Bloomberg.
How much of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan's society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
I don't see that happening at all. I see us as raising to a level that we believe is restrictive enough to bring inflation down, and then holding it there until we see inflation truly get close to 2% and demonstrate that price stability is restored.
I'd like to reach a point where policy is moderately restrictive, somewhere between 4 and 4.5% by the end of this year, and then hold at that level and see how the economy and prices react.
FOMC members Mary Daly and Raphael Bostic saying that the Fed is unlikely to cut rates next year. Now, that's as traders bet on at least one reduction in 2023. Now, Karen Carniel-Tombor from Bridgewater Associates is still with us. Karen, first of all, there is a belief in the markets that, again, going back to that Goldilocks scenario, that they can have it both ways. But I feel like Fed officials have just been saying the same thing, which is we will stop at nothing to keep inflation under control. So if that's the case, if that's your interpretation, where should Treasury and equities be?
Well, I think that an important thing to keep in mind is that the Fed's job today is actually not that hard yet. I think it's only going to get harder because right now they're in a situation where the economy still looks pretty great. So they can say we're going to prioritize inflation because they haven't actually seen any real economic slowing. I think what's going to happen in the next few months is it's going to get a lot tougher because the economy will slow. They've hiked enough. There are enough hikes in the system. And we know from past cycles that there is a lead lag. There's time from the rates rising till you actually get the slowing making its way through the system. So they're going to start seeing, better inflation numbers, worse economic numbers, but be in this spot that's going to feel terrible because they're not going to want to slow the economy further. But while inflation will slow, it's not going to get to the numbers that they're hoping for. So I think it'll be a much tougher call for them in a few months. Right now, my guess is they're going to stay roughly like what's priced in. They're not going to want to kind of upset the apple cart. They're going to try to do roughly what's priced in. Once the economy starts slowing, they'll have a tougher call. And my guess is they're going to need to start having aggressive hikes again in order to make sure that inflation actually gets under control and suffer a lot more economic pain than they're hoping to.
Karen, what's your take on China? Could it be that actually it's much worse than expected, and that would also justify the OPEC cut?
I think that China is worse than expected in the sense that, look, China is the most disconnected economy. It definitely has its own cycle. It's easing and tightening at its own pace. It already has had a pretty deep recession, and it's trying to stimulate relative to that. But its stimulation has not been super effective, and they haven't kind of pulled out all the stops, if you will, because while they're not constrained by inflation, they're the one economy in the world that doesn't have a major inflation problem, they do feel constrained by a lot of other issues. They really want to change the quality of growth. They want to make sure that the property sector actually delevers. They want to make sure that, basically new debts don't get created as a way of responding to the slowdown. And so they're in a situation where they're not really turning their economy around in a huge way. They're not going to be in a deep recession, but they're not going to be the global engine of growth that can offset how weak the rest of the world is going to be. Yeah. And that means that, especially from a commodity perspective, oil less so than other commodities, but they're a major, major source of demand. Yeah. And if property sector is the thing they need to slow, that's where a lot of commodities go.
Karen, thank you so much for the terrific briefing. Karen Carniel-Tambor, their co-chief investment officer for sustainability at Bridgewater Associates. Now, coming up, demand slowdown, hiring freezes, and the end of easy money. Tech has had a rough ride this year. We'll gauge the outlook at the Investor All-Star Summit next. And this is Bloomberg.
Recently, cryptocurrencies have been very popular. And if a client came to you and said, look, I'd like some cryptocurrencies in my portfolio, what would you say?
Oh, we've actually been really deep into crypto, deep into learning about blockchain, and all of the new businesses. You know, I would characterize this as crypto learners. You know, we have made a series of toehold investments on behalf of our clients, both in some of the currency baskets as well as with some venture firms that are investing primarily in the crypto area. I think it has the potential to be completely game-changing, but it is still such the Wild West, and so it's so uncertain. But it has the potential to completely upend everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrell. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to Tom McKenzie, who's at the All-Star Investor Summit at Hotel Café Royal in London with a guest. Tom, over to you.
Francine, yes, this is a perfect environment to talk about what is happening within the tech sector at a time, of course, of higher rates and valuations coming down. European tech companies have raised about $56 million this year. So it's not all bad news, but of course it is a more challenging environment. And what better person to speak to about this than a partner from one of the leading VC firms across the continent, MMC Venture Partners. And one of the partners, Mina Saman, who joins us this morning. Mina, thank you for coming onto the show. Let's start then with this environment that tech is facing. Higher interest rates, lower growth, and a lot of pressure to cut costs. Is tech being brought back to earth at this point?
First of all, thanks for having me, Tom. I think we're at a quite interesting space within the ecosystem. We came off 2021, which was incredibly high. I think 2022, we're back to more rational investing at the early stage. Yes, companies do have to look at their cost base, and some might say it's a tough time to be a founder, and I'd probably agree with that because you're having to look at your own operations and your runway and when you might next raise capital. So we are seeing across the board some level of cost cutting, but where there's great companies, they will still continue to invest in growth.
It does bring to mind that famous Warren Buffett quote, when the tide goes out, you see who's been swimming naked. Are you seeing a tick up in failures?
I think there will be. Don't forget, a lot of companies raised a lot of capital last year, so there will be many that do ride the storm, but it's a matter of which companies become the acquirers versus which ones are the ones that get acquired ultimately.
Have valuations troughed?
We've seen them come down, so we invest at the very early stage, so at the Series A, and obviously public markets have come down and that has trickled down. And so at the start of the year, there was a big mismatch between investors and founders just from a valuation expectation. But now we're seeing that come back together for sure.
Some of your kind of most high-profile investments include the delivery service Gusto, but also Copper.co, which provides services to institutional investors within the crypto space. Let's start there. Given the ruptures within crypto, Bitcoin's trading at $19,000. What is the case still for a company like Copper.co in the months and years ahead?
I think you have to think of Copper as not directly impacted so much by crypto, but selling infrastructure, and so enabling big institutions like a BlackRock or State Street or whoever it might be to have access to those cryptocurrencies. And we're still at a place now where we're seeing adoption through those large institutions, and today is a time where investing in that infrastructure for when the crypto markets do come back, for them to really have a product and products to sell.
What are the investments you're most excited about in the 12 to 24 months ahead?
I think there are a few really interesting areas that we look at, and we're thematic research-driven investors. One of the areas that we're looking at today is what we call data infrastructure software impacting healthcare, financial services, and security. And over the last 5 years, we invested a lot in AI, where data was available, and so you can automate a process or apply AI to do analytics. And over the next decade, we think the value is going to accrue at the infrastructure layer, where new softwares are going to be created to accelerate AI or create new data sets to impact those industries.
Okay, data infrastructure. That is a call there from Mina Saman, a partner at MMC Ventures. Thank you very much for joining us on the views around valuations that we're seeing becoming a little bit more rational within the tech space. Yes, it is a more challenging environment given the run-up in rates that we've seen. And we are starting to see, and Mina is highlighting this, cost-cutting across not just his portfolio companies, but companies across the tech space, as, of course, companies look to become more lean in an environment of slower growth. This is the Europe All-Star Company event. It happens once a year here in London, and it really does focus on some of the innovation, creation and technology that is driving some of these companies going forward. So it's an exciting time despite all of those challenges. We're going to have plenty more through the hours ahead. Do stay with us. This is Bloomberg.
Why does everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO. I have a problem I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
I'm Kaylee Lines.
And I'm Damian Sassower. Join us each week on our brand new show, The Lineup. If you're betting on the Mets, it's a pretty good return.
We'll cover the latest trends in sports betting, the hottest matchups, shifting spreads, and the data you can't find anywhere else. It is crazy how much the money line has changed from the preseason to now.
Plus, expert insights from special guests.
The Eagles got a gem on their hands. I hate to say it because they're in the NFC East with the Giants.
Odds are it'll be your favorite way to stay in the game.
Catch The Lineup Fridays and Saturdays only on Bloomberg.
Not so pumped. The U.S. slams OPEC Plus for its decision to slash crude output, saying the cartel is aligning with Moscow. Rallying cry, Ursula von der Leyen calls for EU intervention in gas markets. Regional leaders meet in Prague to seek common ground. Plus, pivot. What pivot? Fed officials pour more cold water on equity bulls. Mary Daly tells Bloomberg that an early end to tightening is wishful thinking. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, £300 billion has been wiped from UK stocks and bonds over Liz Truss's first month as Prime Minister. It follows the market rout over her government's sweeping tax and borrowing plans. You can see our next guest sitting to the right of the UK Chancellor. She's one of the top city bosses that the Chancellor met to try and restore market confidence. Well, I'm very pleased to welcome Tina Lee, Chief Executive from the UK and Ireland at Deutsche Bank. Tina, always such a pleasure to speak to you. You make me smarter on what we should be looking out for in terms of pitfalls, but also opportunities. First of all, what's your take on the UK right now? You sat next to the Chancellor. Yep. There's, obviously a credibility problem that was played on the markets. Can they get back on their feet?
I think they can. I mean, there's been a lot of sound and fury that we have seen over the last 10 days. And I think the work that the Bank of England has done in terms of announcing their gilt purchase scheme has clearly calmed markets. And we've seen that in where sterling has moved to levels where it was before the mini-budget. And gilt yields have obviously stabilised, even though at much higher levels. So I think we have a pause here. The question, obviously, is around the medium-term financial plan. Yep. That is on November the 23rd. That will be coming, obviously, with the OBR assessment, which I think will be key, and that was one of the things which spooked markets because that was lacking with the mini-budget statement. So I think for me the question is, given that the Bank of England will conclude, or allegedly conclude, their purchase scheme by October the 14th, what happens between now and the 23rd? So much of that is around, I think, communication with the market. That was missing.
Which is strange because they also put the markets, or certainly the city, at the kind of the forefront of their plan.
That's right. That's right. So I think that started to happen. We saw the coordinated statements from the Chancellor and from the Bank of England early last week. The purchase scheme was helpful, and also maybe some of the statements which have been coming out of the Chancellor with regard to his commitment to fiscal discipline.
Tina, when you look at the Bank of England and the fact that they're starting QT, I don't know whether they need to wait or whether this is something that would make a huge difference for your bank.
So QT, I think, is a programme that the Bank of England has spent quite some while preparing the markets for. So the Bank of England will still be committed to that programme. What happens, though, is more focused on the short term. In other words, do we actually see a slight adjustment to that programme? Do we see an operation twist type option where perhaps the Bank of England may buy long bonds and actually sell short gilts? But that, I think, remains to be seen. So I think QT is absolutely on the cards, and that's something which we're anticipating is going to actually play into the supply of gilts for 2023.
I think you also have some great new headquarters in London, right, in a year. How committed is Deutsche Bank to London and to the UK?
We are very committed. So I think, as you rightly say, we've got flagship headquarters, which is right now under construction and will be moving in October of next year.
And so what does that mean in terms of your role, though, for your clients? Will your role change given the uncertainty in the UK? So is it, attracting investment? Is it clients elsewhere that see opportunities because of pound, or are people pulling back right now?
No, absolutely not. I mean, we have so many clients here in the UK, and as you know, London is a great cross-border financial centre. So that was actually very much the crux of the conversations that we were having with the Chancellor and his team last week around actually how, as an industry, we can continue to support London as a leading global financial centre and continue to attract capital and talent into London. So I think that is not just about the short term, that's also through the medium term as well.
But the UK, and especially London, seems to have lost quite a lot to Amsterdam in terms of IPOs and things going through the pipeline. Do you think this government understands what is needed to get that back? I know there was also talking about, for example, ministers being able to supersede some of the regulators in attracting IPOs.
Yes. So, I mean, IPOs are really at the end of the value chain.
Yeah.
And actually the focus, and again, some of the key messages that we've delivered to the Chancellor and his team is around the need to support startups, to support seed funding, and actually make sure that those high growth companies actually stay in London, and IPOs actually fall out of that in 2, 5, 10 years' time. So for us, it's a long game. This isn't something that can either change for the positive or the negative overnight. It's really commitment to London as a financial centre that's really important.
Do you think you'd play a role also, further north or in branches elsewhere?
You mean in the UK?
Yeah, in the UK.
We already have over 1,000 people in Birmingham.
Yeah.
So that is a centre which we will continue to be investing in, and we also have operations in Ireland as well. So the UK will continue to be a significant region, really, for Deutsche Bank Group, both in terms of profitability, but also the depth of talent that we're able to source here in the UK.
I have a million questions also on, the relationship between the UK and, of course, Europe on clearinghouses and things like that. Would you move people? I know you've already moved some people, right, to continental Europe.
That's right. I mean, for Deutsche Bank, we've always been very fortunate in the sense that we have such a significant operation already, not only in Frankfurt, but in the other European hubs. So we have moved people in the low hundreds. That's working incredibly well. And we continue to monitor where it's best placed for our people to be, both in terms of sales coverage, but also in terms of risk-taking.
What's your biggest challenge right now? I mean, there's a lot happening in the UK. It's also, I guess, trying to get people still to return to the office. I imagine some of them want to work from home. As chief executive of the UK, I mean, you're juggling so much. What do you think is hardest?
So I think the hybrid working side of things, we've actually had lots of people return to the office. As you would expect, sales and trading are in 5 days a week. Yeah. Really the challenge is around our infrastructure functions, not around getting them in, but actually making sure that there are reasons for them to come into the office. And that's really important. So that's not just about me messaging that I'd love to see more people around Deutsche Bank and around our offices, but also making sure that our leaders and our managers across the whole region really make it worthwhile for our people to come in.
Do you need to pay them more because of inflationary pressures?
Not necessarily. I mean, we're very mindful to cost of living. We're mindful to what inflation looks like here in the UK. I think, as we know, we're expecting CPI to peak at something like 11% by the end of this year. And we're looking at the talent market. So there will be pockets where the market for talent is extremely hot. We seek to remain competitive. We're not looking at wholesale increases in terms of salaries, in terms of addressing the cost of living crisis, but we are very focused on being competitive.
Overall, do you think this government will be business friendly after the mayhem that we saw over the last 10 days? Do you think they'll be good for activity, they'll be good for business, they'll be good for the City of London?
So I think what we have all welcomed is the engagement actually from this government, both in terms of wanting to hear directly from industry, and I should say not just financial services, but from business more broadly. Clearly the growth agenda is a key priority for this government, and will be critical in terms of how the market assesses the medium-term fiscal plan. So it's not a question of top-down. They're very keen to hear from practitioners what we can do to help support that growth agenda.
So what would you need from them? I don't know whether there's too much red tape or, again, it's regulation that needs to be loosened up a bit to be able to rival other European capitals.
So I think there's always room for improvement when it comes to the regulatory framework. However, in my view, I think it's more about streamlining rather than sort of wholesale change and a race to the bottom. So for me, it's very much evolution rather than revolution. I mean, remember, we have some of the most sophisticated regulators here in the UK. And for me, that is actually a necessary foundation for stable and financial markets.
Yeah, but some people say it's too regulated, right? It makes it more difficult because the regulation is so high compared to other places.
That's right. And I think that the government is open to actually hearing that. And I would say actually our regulators are too. So I think watch this space. It's early days, but I think there's lots of areas where the breadth of regulation and the number of regulators potentially can be streamlined.
When you speak to a lot of your clients, are they ready to put more money in the UK in terms of investments, or is it a little bit of a wait and see because of the shock of the last 10 days?
I would say that some clients are pausing. Yeah. And I think that's reasonable. As I said, we have a period of time between now and November the 23rd. We have seen we have seen sterling depreciate somewhat against the US dollar. That's now recovered to about the 112, 113 level, which is where it was before the mini budget. But obviously, I think we should be very mindful of the value of sterling because that does have an ultimate impact in terms of the value of UK PLC.
Yeah. Do you worry? I mean, one of the things that we've been looking at is mortgages, which I don't think impacts you directly.
No, that's right.
But does it impact, I guess, the viability of certain firms? Do you worry that certain customers in the UK will go bust because of what we'll live through in the next four months?
So I think, as you said, for Deutsche Bank, that's not a sort of a relevant impact. So for us, it's really second order in terms of the impact for us. We really are focused on speaking with our UK clients and really helping them navigate what are really tricky markets in a rising interest rate environment.
Tina, thank you so much, as always, for joining us. Tina Lee, their Chief Executive Officer for the UK and Ireland at Deutsche Bank, joining us for an exclusive conversation on the City of London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The World Trade Organization says global trade will slow next year as major economies face strong headwinds. The WTO is forecasting that global goods trade will now grow by 1% next year, a big revision on its previous estimate of 3.4%. It blames a cocktail of factors including rising prices, restricted energy supplies and growing US-China tensions. German factory orders dropped in August, hinting at a lack of momentum as Europe's biggest economy stands on the brink of a recession. Demand fell 2.4% from the previous month, though data for July was revised upwards to show a gain. This came after the late reporting of some large aerospace orders. North Korea has fired 2 suspected short-range ballistic missiles towards waters where a US aircraft carrier had been deployed, making a total of 10 launches in less than 2 weeks. That's one of its biggest test barrages under leader Kim Jong-un. The firings came shortly after Pyongyang condemned the Biden administration for escalating tensions. And King Charles is expected to be crowned on June the 3rd next year in a ceremony at Westminster Abbey. Bloomberg has learned that the British officials are converging on that date, although talks are still ongoing. The coronation comes almost 70 years after his late mother was crowned and will form the centrepiece of days of celebrations to mark the beginning of the monarch's reign. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Calls for a street party, Francine.
Always a street party. I'm always in. You organize, if I get my voice back. This is, Leanne, all the street partying that you and I have been doing. Except you keep your voice. I lose it. This is the problem. OPEC Plus, let's get back to business. OPEC Plus defies Washington, agreeing to the biggest production cut since 2020. Now, we'll bring you the very latest on that next. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one, and through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the US shaped the 20th.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, OPEC Plus has agreed to cut its output by the most in 2 years, earning a rebuke from the White House. Meanwhile, the EU approved new sanctions on Russian oil, drawing a veiled threat from Moscow. Now, let's head to Vienna again, where Bloomberg's Manus Krani is standing by. Manus, first of all, great interviews. So what's the latest?
Fran. Well, the latest is job done, isn't it? Mission accomplished. Markets up 6, 7, 8, 9% in the space of 4 days. Or is it? Are we about to embark on a very serious period of conflict, having Joe Biden expended a great deal of political capital on a rapprochement which might be under reconsideration? The message is very clear. We're worried about price caps. The message is doubly clear, which is for Russia, price caps could mean production reductions. But the Saudi minister, His Royal Highness Prince Abdulaziz bin Salman, we're not here to deliberately jack up prices. No, Manus, I'm not setting the stage for jumbo cuts to come. This is about moving on from a monolithic issue, which was COVID in splendid isolation, to a whole host of uncertainties. But of course, this was the issue as to whether he likes to keep speculators ouching like hell, and whether that job was done. Let's take a listen to the Prince.
Masochist or a sadist, but I was talking about more to do with making sure that we have disciplined market, a market that serves its original purposes, which is a market that has sufficient liquidity. That liquidity has been hampered by extreme volatilities. Extreme volatility, unfortunately, bring premiums to become very expensive.
And that market is still fragile, it is still illiquid. There's a warning shot there from His Royal Highness. But of course, it's about the volatility, Francine, that could come from price caps. And that's perhaps the deeper story at play here in OPEC+. The known unknowns and now the unknown knowns. Francine.
Yeah, I feel like it's all falling apart. What's next for Saudi-U.S. relations?
I think Saudi-U.S. relations are going to be tested. This is where, you know, the adults need to stand up in the room. You've had the Biden, Jake Sullivan immediate response in the depths of the press conference. SPR, you want to cut? You want to cut by 2 million barrels a day? I will see you and raise you. I'll go for an SPR release. And you know what? If you want to get frisky with me again, I'll unleash the hounds of Congress and raise the spectre of NOPEC. That might get everybody ouching a little bit more in the building behind me. But when it comes to the Russians, they are much more focused on the price caps. But these relationships between the USA and America, his brother came and fist bumped the President of the United States of America. That's called global political capital. Francine.
Yeah, it certainly is. Manus, thank you so much. Manus Cranney there with the very latest and, of course, talking about his 2 great interviews. Now, sticking to energy, for more on this, let's also get in Maria Tadeo, who's live for us in Prague this morning, where an extraordinary summit is being held. So, Maria, the head of the Commission, Ursula von der Leyen, calling for a gas price cap. Will it actually happen?
Yes, she hasn't, Francine. Now she's put it on paper. This is a letter she sent out to all the heads of states of the EU 27 countries yesterday, in which she argues when you look at the prices in the Dutch benchmark, the TTF, it no longer reflects, according to the head of the Commission, the real cost of gas. And therefore, the European Union needs to transition away from it. And that means temporarily a cap. The problem is, and this is the fundamental issue, is that you have a growing number of countries that call for it. The Commission now responding on paper, but they can't agree on a formula. When we talk about a price cap, Francine, there's at least 5 different options on the table. And then the other issue is that Germany is still not behind this idea. And then there's the ramifications potentially. If prices do go down, then maybe demand destruction will not be as intensive as it needs to be. So then you're back to square one.
Yeah, the problem with all of that is that there's also politics in the middle. So what happens in the politics? You have 44 heads of states, and I think the UK Prime Minister is also arriving.
Yes, and Francine, she is here today. It's finally confirmed. Remember, at one point, there was questions as to whether or not she would attend this meeting as a European political community. Of course, countries that are members of the EU, but also others that don't. And the idea here is that they can sit around and debate issues they have in common. Now, for Liz Truss, she gets to step away from her domestic problems for a few hours, potentially meet with Emmanuel Macron. Remember, a few weeks ago, she was asked, is he a friend or a foe of the UK? And she said the jury's out. Maybe today they clarify issues, also issues around Brexit. And then you have the Ukrainian question, which is still the perennial debate here, especially because the Turkish president is going to be here too. And he has been key in that grain deal, which could perhaps expire going into the winter. So there's a lot of Ukraine too here.
Maria, overall, I mean, when you look at the different players, who are the heads of state that you'll be watching out more closely for?
Well, Francine, today really is Emmanuel Macron. This is his baby to some extent. He was the one that pitched this idea. And when I spoke to French diplomats yesterday, they say to some extent this is already a win for French diplomacy. The fact that we're here today in Prague and this meeting is called the European Political Community may actually help to reset some of the difficult relations like the UK, but not only. And then, of course, it's Olaf Scholz. You know, there's a lot at play with that mega package, 200 billion euros. Remember, Francine, it's sparked a lot of tensions, and there is a feeling here that Germany still has some explaining to do.
Yeah, that's absolutely right. Maria, thanks so much. Maria Tadeo there in Prague for us. Now, coming up, we stay in Vienna throughout the morning to bring you the very latest on OPEC's biggest production cut in 2 years. This is Bloomberg.
No one covers the world like Bloomberg.
The pressure cooker just got far too hot in Birmingham for the government to handle.
You foresee 2/3 of the crypto hedge funds will disappear. Are we close?
The European Union will support and defend Ukraine's territorial integrity.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
much of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan's society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Bloomberg has learned that Elon Musk and Twitter have agreed to postpone the billionaire's long-awaited deposition in the company's lawsuit. Musk reversed course earlier this week and said he was committed to going ahead with the $44 billion takeover. The move comes as lawyers trying to finalize procedures to dispose of Twitter's lawsuit. Now, German factory orders dropped in August, hinting at a lack of momentum as Europe's biggest economy stands on the brink of a recession. Demand fell 2.4% from the previous month, though data for July was revised upwards to show a gain. This came after late reporting of some large aerospace orders. Virgin Atlantic is pulling out of Hong Kong for good. The UK airline is cancelling flights and closing its offices in the Asian financial hub, ending a 30-year history with the city. It says one key factor is closed Russian airspace, which extends flights between Heathrow and Hong Kong by at least an hour. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Katie Lyons in New York, and Edwards in London, and this is Bloomberg.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball so their apps would surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are in Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg. I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
A market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This has been an incredibly tough year for the bulls. It's been a great year for the bears.
There's a lot of distortion in the data.
It's really about finding what's going to work in a persistent high inflation environment.
I think that there's a concern in the broader financial markets that something might happen within the U.S. markets.
It's just the uncertainty factor that's keeping markets on edge.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Traders versus the Federal Reserve. They keep betting that the central bank will cut rates next year, even though Fed policymakers keep saying that they won't. The OPEC plus oil production cuts. The Saudis snubbing President Biden and helping Putin. And European leaders meet in Prague. The summit will be dominated by the energy crisis and the war in Ukraine. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Kaylee, the European market's kind of catching up with the US of yesterday today. The global vibe, though, seems to be trying to work out what the significance is of those production cuts from OPEC, what that does to inflation and to global growth.
Yeah, and we're going to have more on those stories in just a minute. And of course, by extension of wondering what it means for inflation, there is a question of what it means for central bank policy, as we've had the pivot conversation revival in recent days. And of course, that is something they also pay attention to in Asian markets, where it really was a mixed picture for equities overall. You did have the MSCI Asia Pacific Index as a whole up about 0.3%, in part due to gains in markets like Japan. But you had some underperformance as well coming from Hong Kong, which saw some of the gains of yesterday, the best day for 6 months in the Tuesday session, retreating a little bit, with the Hang Seng down about 0.4%. Now, as I raise the central bank question, of course, you've had Fed speakers pushing back on the idea of a pivot, pushing back on the idea of rate cuts coming in 2023, and that has put some more upward pressure on bond yields. In Australia, for example, overnight, the 10-year yield rising 14 basis points to the 377 level. One interesting thing I wanted to point out in foreign exchange as well, the South Korean won stronger against the dollar for a fifth day in a row. That is its best 5 days against the dollar going back to the spring of 2020, strengthening by about 0.6% this morning, trading right around the 1400 level, Matt.
All right, we are looking at S&P futures that are down this morning after a down day yesterday. Although it should be mentioned, we were off a lot more, and Wells Fargo has come out and said they believe that one options trade yesterday provided a big bounce in the market because market makers had to reposition themselves by going out and buying the underlying equities. So really interesting trade. Great story in the Bloomberg. Recommend you check it out. Nonetheless, looks like we're headed back down again today. Only 0.4%, not looking at the 1% plus drops in futures that we saw yesterday at this time. We do see the Bloomberg Dollar Index starting to climb a little bit, though. And if you looked at the chart, the one-day chart of this, you would see that it had come down and is now going much further back up. So the gain of only 0.1% on the dollar index doesn't look terribly significant until you back out and see from where we've come, or from whence, maybe? I got to ask Anna about that. The 10-year yield right now barely changed, but at 3.75, so still at a relatively high level. And again, this is a case of a yield that was down and has come back up through the unchanged level into, well, for a moment, into positive territory. Nonetheless, the point is it's come up from a lower level. And NYMEX crude as well, 87.82 after the big cuts that we got yesterday from OPEC and all the surrounding stories about how OPEC may be siding now with China and Russia. We saw some gains in this market, although they're not quite so pronounced. You see 2 million barrels a day, Anna, and you think we're going to see a huge jump. We have seen forecasts, though, for bigger gains in Brent especially, right? Goldman Sachs says 110 a barrel now by year end.
Yeah, absolutely. From whence we came, I don't know, sounds maybe right, Matt, but even here in ye olde England, that sounds a little old-fashioned, so maybe not. Let's have a look at European markets. We've got European stocks giving us a pretty kind of mixed picture right now, fairly flat, either side of the flat line, down 0.25%, and that is, again, an oil story, down by 0.25% there. The CAC 40 fairly flat, the DAX up 0.1%. Let's have a look at where we are on some of the fixed income stories and energy stories across Europe, because these are having an impact. There's a big focus, once again, on the long end of the UK gilt curve. Yes, we know the Bank of England is operating here. Yes, we know that they're doing quantitative easing. Essentially, they're buying some of the bonds in the market there to stabilise the market still. They haven't been doing that so actively over the last couple of days. But a lot of people are asking, what happens when we get to the end of the cliff edge? We've seen mortgage rates rising in the UK, and that's adding to concerns about how this spreads into the underlying economy. Conversations going on about that. The Italian 2-year yield in focus as well. We had seen this yield rising. We've seen the 10-year yield rising up till pretty recently. And a lot of this to do with concerns about where BTP yields go if we start to see the new government in Italy trying to take fiscal action to support the economy there. One of the ratings agencies out with a warning to watch that and watch those developments. Brent crude, Matt's already talked about where we are on oil, only up by 0.2%, to Matt's point about how we haven't seen outsized reaction perhaps to those cuts in production. Are they really going to be as much as billed? And have we seen a big run up in prices in the expectation of these cuts? Both of those could be true. But as Matt says, 110 is the call now for some. We've seen Goldman Sachs, Morgan Stanley and UBS all talking about going north of 100. And Shell, despite the fact that we have a broadly supportive environment for oil prices, then Shell is losing ground today, down by 4.4%. They put out a trading update, Kaylee, and some analysts talking about that being a little bit weak in terms of their performance.
All right, Anna, well, let's get back to the central bank story, because Fed officials keep repeating the mantra that they don't plan to cut interest rates next year. San Francisco Fed President Mary Daly and Atlanta Fed President Raphael Bostic were the latest to bang the drum on the need to keep tightening in place to reduce inflation. Mary Daly spoke to Bloomberg's Michael McKee in an interview yesterday.
I don't see that happening at all. I see us as raising to a level that we believe is restrictive enough to bring inflation down, and then holding it there until we see inflation truly get close to 2% and demonstrate that price stability is restored.
Bloomberg's Danny Berger joins us now for more. So, Danny, their message is clear. The question is the market receiving it?
No, not really, to put it just flatly, Kaylee, because we are still pricing in cuts for next year. So for our radio listening audience, I have the euro-dollar curves up on a chart in front of me. I'm looking at next year's, what's implied for rate cuts and for 2024. So at the moment, we're implying one rate cut in 2023 of 25 basis points and at least two in 2024. Again, this is not what the Fed is saying. Both Daly there and Bostic yesterday saying we're going to hike rates, and then once we get there, we're staying at this restrictive level to make sure that we have conquered inflation. So that's potentially why we will see more jittery markets against things like tomorrow's payrolls report, because we're looking out for any of those clues if there are cracks that would allow them potentially to cut next year. But for the time being, no, the markets are not listening to the Fed saying that they will keep rates restrictive.
Danny, I also saw a great story on the Bloomberg last night pointing out that world currency reserves are shrinking to the tune of about $1 trillion, or about 8%. That's a big drop.
Not only is it a big drop, Matt, but for that level of it happening in the first half of the year, that's the most that we've ever seen since the Bloomberg data, which goes back to 2003. At heart of the issue here is the fact that the dollar is rising. So all of a sudden things like euro, yen, all those other reserve currencies, they've become less valuable. Then at the same time, you have treasuries selling off. So if these foreign reserves are in the form of treasuries, that's all of a sudden less valuable. And these countries are spending on energy. So it just means that the firepower they have in their tank to spend to defend their currencies is significantly lower because they're not going to get the same amount back, for example, if they were to sell off treasuries or U.S. denominated assets right now. And so at the moment, a lot of these countries still have enough FX reserves to continue to defend their currency. But the thing is, the Fed, as we were just saying, isn't going to pivot. So this could potentially just continue to deteriorate and continue to deteriorate the firepower of countries to defend currencies.
Yeah, and absolutely. And Danny, we've talked a lot about, of course, the Japanese doing this, but India, the Czech Republic, others also spending big on that front. Danny, thanks very much. Bloomberg's Danny Berger with the latest on those market themes. Let's turn to one of the important drivers today, and that is oil policy. OPEC Plus agreed to make a large production cut to keep oil prices high, drawing an immediate rebuke from the United States. The move was defended by ministers from the producers group as necessary to protect the oil industry and their own economies from the risk of a global slowdown. Bloomberg's Manus Crowley joins us now from Vienna. Manus, what did you walk away with from the last 24 hours? What stands out to you?
Look, I think it's a confluence of C's. It's the cuts which are sizable, but how real are they? The cuts, the caps, the price caps that are coming, the capital, the political capital which has been expended by the White House, and in some ways perhaps rebuked by not just Saudi alone, but by the OPEC Plus, by the arrival of Alexander Novak here